The U.S. economy is just doing so much better than the rest of the world.
This is a period in which U.S. dominance of the global system is going to increase, both for positive reasons and for negative reasons.
You're really going to start seeing the market focus on the impact of tariffs.
There seems to be something about political leadership transitions that help usher in some leadership style transitions within the U.S. equity market.
Markets have trouble pricing election risks, period.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
From New York City, for our audience worldwide, good morning. It's Bloomberg Surveillance alongside Danny Berger and Manus Cranny today. I'm Anne-Marie Hordern. Lisa Abramowitz is on assignments, and nearly 30 hours of TV last week. Jonathan Ferro is taking a much-needed day off. Today in the markets, they're still pricing in a Trump trade. This is after the S&P 500 secured another record. I find this fascinating, Danny, because the market seems to think we are going to have a trifecta, even though we are still waiting on the balance of power in Congress. We don't know the makeup of the House.
That small cap rally is so telling. 1.2% on what? On basically nothing, just a continuation of the Trump trade. And Anne-Marie, part of the reason it's so significant is we get a lot of data this week. We have CPI and retail sales, usually on a Monday. Ahead of that, we patiently wait and see what happens. But for this market, the politics is more important than the data.
Politics more important, though, Manus, I imagine for the Fed this week, the data is going to be important. Neil Kashkari over the weekend talking about the fact that the job is not done to get to 2%.
The job is not done, and then you've got to ask yourself the state of play in terms of the break-evens. This market is hesitant to see the trajectory back to 2%. There's a couple of other lines that he mentioned, and I think this is important in the context of what is deliverable under the deportation czar that has been appointed. There's three lines that he actually mentions. One is the risk of tit-for-tat tariffs, and he's concerned that the deportations could cause disruptions for some quarters. Now, this is the whole point. This administration, if you look back at Trump 1, they never actually deported as many people as Obama did in his first and second term.
I love this. It's the playbook. Basically say, it depends. We don't know. It depends how it plays out.
Yeah.
It is different from the Powell playbook, which was just no.
And a lot of it depends on personnel, because we know in Washington, personnel is policy. And actually, that's why, and Danny, you brought this up earlier, we actually saw the dollar strength into the weekend because that FT report that Robert Lighthizer, the tariff czar, will be going back into the administration. Let's take a look at where the markets are trading this morning. We do have the euro dollar lower on that news. Dollar strength really across the G10 for some of this personnel is policy, 106.69 there. A lot of strategists are coming in and saying, look, we might see parity. And WTI this morning, this also drew all China demand under 2% lower, 69.19 on New York crude. Coming up this morning, Marvin Lowe of State Street as U.S. equities hit another record high. Former State Department spokesperson Morgan Ortgaus on President-elect Donald Trump's foreign policy priorities, and Sucharita Kodali of Forrester Research as retailers prepare for those looming tariffs we were just talking about. But we begin this hour with U.S. stocks looking to set new record highs. After the re-election of Donald Trump, Marvin Lowe of State Street writing this: markets were always inclined to rally in the event of a Trump presidency, and true to form, asset classes have performed as expected, an indication that investors were not broadly positioned for his solid victory. Marvin joins us now. Marvin, good morning. Thanks so much for kicking off the week for us. You would think that maybe markets were over their skis, especially given the fact that we don't have the trifecta yet. Yes, the Republicans are poised to take the House, but you don't have the trifecta yet. But you think this has more room to run. Why?
I do. I do think that the market is increasingly trading the red sweep. The Democrats certainly have not made the progress, even though we're waiting for votes to come in. And the general momentum, if you will, that Trump kind of brought to the voting booth is something that investors are willing to bet on. Probably more important is that our investor behavior, which kind of looks at real money, both holdings and flows, didn't really see that investor group go heavily into a Trump trade, if you will, before the election. So in a lot of ways, they're catching up as it becomes more clear that, we might have a very good chance that we have a unified government, at least this time around.
Right. The past week would have been so painful if you weren't in equities. But for treasuries, Marvin, we had talked the day after the election. Yields were up, somewhere between 10 and 20 basis points when we spoke. And you said this makes sense. This can stick. However, it didn't stick. On the week, 10-year yields ended lower by 8 basis points. What do you make of that reversal?
Yeah, I mean, it's going to be a choppy process for sure. The market was overly short kind of going into this. We didn't get any surprises from Powell. What I would say, however, is even though duration outperformed, when you kind of look at the term premium components, which is where I focus on in terms of structural shifts in what the market wants to value duration at, you still see term premiums picking up. So that actually is probably more difficult for risk assets to deal with, once we get to some higher levels. So, I'm still convinced that the market is going to eventually have to push back. If not, the administration will, certainly try to grow this deficit because it'll view the market as saying it's okay.
But this is the thing, Marvin. It's a market that has a lot of inputs it needs to grapple with. You mentioned the Fed just briefly in what you were describing. We're going to get data this week, CPI and retail sales. Is this a market that will be moved more by the politics or by the data?
So I still think it's the politics that are moving things. If we're talking about the bond market, the short end of the curve is probably going to be moved more by data because that's something that we can measure a little bit more in terms of what the Fed's response function is going to be, at least for the next couple of meetings. Nobody really knows how the Fed's going to approach the administration in the middle of next year. But short term, whether or not we talk about December, whether or not we talk about a continuation going into January, that's data. Longer term, it really is politics, and how much as you mentioned, this might or might not go down. The other thing might or might not get implemented. Once we get an idea of what policy actually looks like, then we can really start to price in what type of term premium we need and what type of valuations should go along with those term premiums. What I would say is that right now, kind of those term premiums are still relatively low given history, and valuations are still relatively high. So that equation, if you will, is a bit of a challenge if, in fact, we see spikes in term premium, which we've started to see over the course of the last couple of weeks.
Marvin, good morning. Probably the most shocking thing was you saw the 2-10 curve back at the tightest that it's been in nearly a month. So the bond market began to give itself a little bit of a breath at the close of business on Friday. Yeah. That's closed today. Yeah. I like what Rick Reader had to say, which was venturing out to the wild blue yonder of long-term rates. It's a dangerous game, isn't it?
It is if you're trading it for sure. The leverage, kind of the way you're able to really capture convexity on the curve. It is a dangerous game with a lot of volatility.
The other thing that came across my inbox this morning was talking about the performance in credit and the Bloomberg corporate bond OAS, 74 basis points. This is the lowest in a century. So this is exceptionalism personified. How do you look at corporate and credit spreads right now? Because they are so tight, they're so priced almost to the perfection of exceptionalism.
Yeah, for sure. So, if you are a spread investor within the corporate world, it gets harder and harder to buy. Certainly if you're shorting treasuries and you're just looking for more spread compression, you have to wonder how much more it can compress. Having said that, income is generally under-owned in this market, just given how poorly overall rates have performed. So if you want to lock in income, it's pretty easy to see how some of these corporations, particularly shorter duration aspects of it, will do well under the new administration. It does depend refi risk. It really does depend how much we push term premiums kind of going forward. But if you want to lock in income, I still think that's a trade from an overall risk perspective that people are going to put on.
Over the weekend, we heard from Minneapolis Fed President Neel Kashkari, Marvin, and he said rates, it could be a little bit easier than previously expected in terms of how far they're going to go when it comes on this cutting cycle. He almost put a little bit of cold water on December, reading some of the tea leaves, but you think the Fed continues to cut and into next year. How difficult is that, though, when you hear some of these policy proposals coming out of Mar-a-Lago?
Yeah, I mean, every data point is live. The Fed is trying to deal with certainly a set of known unknowns, which makes it incredibly challenging. Having said that, at kind of these high 4% ranges, the Fed still thinks that it can cut. And remember, we've had decent data, but we've also had mixed data. So the jobs market certainly did not look as strong as it did after the last jobs report relative to what we saw in September. So we're kind of parsing that type of environment, which, again, as mentioned, the long end of the curve is dangerous, and it's going to get bounced around based on a lot of these types of inputs that we have to incorporate.
And when it comes to looking into next year, you also say dollar weakness over time, even though we are seeing serious dollar strength across the board. What is going to drive that weakness?
Yeah, I mean, ultimately, we'll see how the tariffs evolve. We'll see how much retaliation goes along with that type of policy. Whether or not we wind up with trade wars, and that does create an environment where inflation can come back. Stagflation actually becomes more of a concern than I think we've seen in several decades. All of that creates an environment where you really do need to be concerned, particularly if you go significantly overweight. But the caveat to that right now is that as these Trump trades continue to make their way into the market, the dollar is one of those asset classes that does have a tailwind. So, I wouldn't be aggressively betting against the dollar at this point for sure.
In that scenario, if we can do some scenario analysis, Marvin, something that looks stagflationary, something where inflation comes back, take me to middle of 2025 through to the end. What do Fed fund futures look like? How far can the Fed go? And are we going to be talking about hiking?
Yeah, I think 3 3/4 to 4%. Right now, the market kind of has it about 3.6 in terms of how low the Fed could go. That's relative to what the Fed said in September when it thought it could go to 2 7/8. So, the market is already saying that there's 50 to 60 plus basis points of rate cuts that it can't get to. If we do get tariffs to the extent that the administration is talking about, 10 to 20% and, upwards of 60% for China. And we do get some of that immediate retaliation. I think we do wind up with stagflation. I do think we wind up with a Fed that is somewhat challenged in getting funds below 4%. So I would kind of think that you still have that kind of play going in there. Probably more important is that the amount of debt in the event that the deficit really balloons starts to really come into the market in the second half of next year. So you've got all of these things that are going along that really, to me, still speaks to a steeper curve, even though we might not get rate cuts as aggressive as the Fed really said just 6-7 weeks ago.
Marvin, what we do know we're going to get this week is CPI, PPI, retail sales. What are you looking forward to?
Yeah, I mean, every data point is live. So CPI is once again expected to be, above averages, above kind of that 2% target. It's going to make the Fed's job that much more challenging. And retail sales really speaking to whether or not this consumer still has gas in that tank, if you will, to continue to spend, even though it's spending down those savings. I think that part of the data that has really made it hard for the Fed is a lot of this confidence data, the soft data, if you will. And with the elections out of the way, and generally speaking, with a Republican in the White House, a lot of the business data starts to pick up. So all of that does spell an environment where I think you continue to have decent tailwinds, both from the political side of things as well as from an economy that's still holding on.
And most importantly, we got some clarity for this market. Marvin Lowe, thank you so much for joining this morning.
Thank you.
Marvin Lowe of State Street. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hackis. Hey, Yahira.
Good morning, Anne-Marie. President Joe Biden will host President-elect Donald Trump at the White House on Wednesday, setting in motion a transition of power that will be completed in January. The two will meet in the Oval Office at 11 a.m. that day. One topic set to be discussed is Ukraine. Biden's national security advisor said in an interview Biden will try to convince Trump not to pull support from the country in war with Russia. And you touched on this. Federal Reserve Bank of Minneapolis President Neel Kashkari said the economy is strong, but the Fed is, quote, not all the way home, and the central bank needs to finish the job of bringing inflation down to target. This after the Fed lowered interest rates by 1/4 point last week in its second consecutive cut. Kashkari also reiterated that another rate cut is certainly possible in December. And a rally in Bitcoin hitting $82,000 for the first time. Of course, getting a boost by President-elect Donald Trump's clean sweep of 7 swing states, plus optimism on a more crypto-friendly Congress. The crypto industry expects a more favorable regulatory environment and potentially the approval of more ETFs from the president-elect's upcoming government. Bitcoin is up 94% so far this year. That's your Bloomberg Brief. Anne-Marie?
Thanks, Yahira. Up next, Biden's final push for Ukraine.
President Biden will have the opportunity over the next 70 days to make the case to the Congress and to the incoming administration that the United States should not walk away from Ukraine.
That's next. You're watching Bloomberg Surveillance. Very good Monday morning. Good morning. This is Bloomberg Surveillance. Lisa and John are off today, joined with Danny and Manis around the table as the market continues to price in further room to grow. As Marvin Lowe just told us, when it comes to this Trump trade, S&P 500 secured another record 50th all-time high. You're seeing a ton of dollar strength as well across the G10. Euro dollar right now, 106.63. Under surveillance this morning, Biden's final push for Ukraine.
President Biden will have the opportunity over the next 70 days to make the case to the Congress and to the incoming administration that the United States should not walk away from Ukraine, that walking away from Ukraine means more instability in Europe. And ultimately, as the Japanese prime minister said, if we walk away from Ukraine in Europe, the question about America's commitment to our allies in Asia will grow.
Here's the latest. Trump's election victory and a potential GOP congressional sweep is raising questions about the future of U.S. aid for Ukraine. The president-elect confirming that two Ukraine supporters, Nikki Haley and Mike Pompeo, won't be joining his administration. This, of course, as Biden is set to host Trump at the White House on Wednesday. Former State Department spokesperson Morgan Ortgaus joins us now. Morgan, thank you so much for joining us this morning. Your former boss, Secretary of State Mike Pompeo, will not be going back into the administration. There was pushback from a lot of individuals in the MAGA world about the fact that Nikki Haley, Mike Pompeo supported Ukraine, what they call neoconservatives. We know personnel is policy. What can you tell us about the names that are being discussed?
Well, first of all, I would say it was going to be challenging with the makeup of the new Congress to get more Ukraine aid through anyway. I think it was headed in that direction. That's also why you saw Zelensky over the past few months saying that he was going to start working towards a negotiated settlement, that he had different proposals he was putting forward. So it's not ultimately a big surprise to me. But when you look at the three names for Secretary of State, you have Rick Grenell, Bill Hagerty, and Marco Rubio from Florida. Susie Wiles, I believe she ran Marco Rubio's one of his Senate reelection campaigns. She's a longtime Florida political hand, and of course he campaigned quite a bit. Has a lot of foreign policy experience, Senate Foreign Relations Committee. Of course, similar for Senator Hagerty, he was actually an ambassador in the Trump administration to Japan, and notably, he wasn't just an ambassador. He had to renegotiate 2 trade deals with Japan and a very contentious military housing treaty with Japan for our troops that are based there as well. Rick Grenell, finally, he does have a lot of experience. He spent over 10 years at the United Nations. He was there in the Bush administration. He was, of course, an ambassador, acting DNI. He would claim, I think, to have been with Donald Trump the longest, to be, quote unquote, the most MAGA, the most loyal. But I would know, even though he is very close to the former president, it's not like he's without foreign policy experience. There is a quite a deep resume there.
When you think of all these names, I think of all of them having a hawkish stance on China, maybe a little bit more adversarial to what's going on in Europe, especially Ambassador Grenell when it comes to Germany. But what about isolationism? Because I don't necessarily view Senator Rubio as an isolationist, the way I do view some individuals in the far right.
Well, the way that I saw the Trump term, the first term play out, I was in the second 2 years of that, is that President Trump surrounded himself with a lot of individuals who would argue and debate over policy, and ultimately he made the decision. I think that people often confused what America First foreign policy means with isolationism. I don't think that they're one and the same. I think what Trump has always said is that he doesn't want to put new American boots on the ground, that he doesn't want to, he doesn't want to see wars like Iraq or Afghanistan, where you end up with people doing multiple deployments over 20 years. I feel like we sort of litigated that as a society on both political parties. There's not really an appetite to be engaged and involved in new wars. He's much more focused on deterring and preventing war. And whenever he needed to take action, like removing the physical caliphate of ISIS in Iraq and Syria, he did that at the beginning of his administration. When he needed to take out Qasem Soleimani, he did that. So he had plenty of actions. I mean, remember, initially, he somewhat surged in Afghanistan. So we'll see if his new personnel and new policy choices are different from the first term. The first term, I did not see him shy away from making bold and tough decisions, and he certainly didn't shy away from trying to deter people like Xi Jinping and the Ayatollah Khamenei.
Morgan, we've also seen Elon Musk emerge as an informal advisor to Trump. He's been on calls with various world leaders with Trump, including Zelensky and Erdogan, reports suggesting both of those. Mm-hmm. What sort of role do you see Musk having when it comes to foreign policy in the coming White House?
You know, it looks like it's going to be an outside advisor role. I seriously doubt that he wants to divest and do a financial disclosure and go before the Senate for confirmation. Maybe he does, but that probably doesn't seem like it's in the cards. But President Trump, clearly had a very big advocate, a very big ally in Elon, and he's somebody who's been involved around the world. From my understanding from public reporting, he does hold a security clearance. So if that is still accurate and true, he would be able to be read into certain conversations. I think it's very normal for presidents to have outside advisors, especially ones that were key and helpful on their campaign, like Elon was.
And Elon, of course, has experience with Ukraine insofar as providing satellites and internet in Ukraine. There was some contentiousness about that. But Trump has said on the campaign trail that he could end the war in Ukraine in one day. What do you think the priorities will be for a Trump administration to achieve a goal to that magnitude?
Well, they're talking about people like my dear friend Bridge Colby, who's written a lot of books on China, who's very focused on China. There does seem to be a sentiment so far in the people that Trump is looking at to be very focused on China, to be focused on our allies in the Indo-PACOM theater. If you want to actually focus on China, you have to stop and be able to bring to a close these hot wars in Europe and in the Middle East. We're seeing, of course, the worst war in Europe since World War II. That's why I have argued quite loudly publicly that while we had the initial sanctions tranche against Ukraine, we didn't follow up, we didn't do secondary sanctions, and really I think a lot of the Biden admin actions over the past 2 years have only prolonged the war, have not sought to end that more concretely. Of course, when you look at Israel as well, you hope in the Middle East and Europe that you can help bring these wars to a close so you can focus on Asia. If they remain hot wars, then you're not going to be able to pivot as every administration tries to do, but unfortunately gets bogged down. So I would think that would be the top of the agenda for sure. And obviously, unfortunately, we still have an ISIS problem. We see ISIS has the capability to stop, for example, Taylor Swift concerts in Europe. ISIS Khorasan has a foothold in every province in Afghanistan. We've been reporting that there was an ISIS smuggling ring at the border. We haven't talked about the border. I can tell you, on the afternoon of January 20th, I'm sure that will be President Donald Trump's very first and most important priority is to get operational control of our southern border back in the hands of the United States and away from the cartels in Mexico.
Former State Department spokesperson Morgan Ortgaus, thank you so much for joining us. Really, it's interesting when it comes to how this Trump administration is going to look. Personnel is policy. She spoke about Senator Haggerty. Maybe he goes to the State Department. And then someone like Ambassador Rick Grenell. But whoever doesn't get state, I imagine, is going to be Manus, his national security advisor.
Yeah, and this is going to raise major questions about the overseas situations. Just think of the conversation that we know that he did have with Benjamin Netanyahu. It's just interesting listening to Morgan talking about Iran. And this is where they squarely are aligned, which is Benjamin Netanyahu and Trump, they see eye to eye on Iran. And this is going to be the next evolution because it's about the amount of oil, not just that Iran is producing, but what they are exporting. And that is where they can do it.
Right. The sanctions are there. What I hear from individuals in this Trump world is that they prepare to enforce them more harshly on day one. All right. Coming up on the program, Nela Richardson of ADP ahead of the latest CPI report on Wednesday. You're watching Bloomberg Surveillance. Monday morning, almost 6:30 here on the East Coast. I'm Anna-Marie Hodern. Alongside this morning, Danny Berger, Manus Cranny, Jonathan Farrow. Much needed day off. He did nearly 30 hours on air last week. And Lisa is on assignment. She'll have some interviews for us later in the week. Let's take a look at where the markets are trading this morning. The Trump train continues after the S&P 500 secured another record 50th all-time high for 2024. It notched on Friday. And you can see across the board, it's moving higher, especially the Russell 200. Look at those futures up 1.3%. This is the Trump trade, the small caps, more growth, more productivity potentially in the United States. Switch up the boards. I want to show the dollar strength. Mattis, look at this. G10, US dollar ripping across the board. 106.64 on the euro dollar. This is the lowest it's been since June. And you have a lot of analysts coming out and saying during a Trump administration, we might see parity.
Absolutely. And we had Mark McCormick this morning, Danny and I, and you also speak to him quite often from TD. And he's saying there is certain inevitability of careering towards that. So it's a trifecta of issues now on the euro. Kit Jukes this morning said, yes, the euro has a problem. It's called Germany. Olaf Scholz looks as if he's going to move up the timeline on his no confidence vote. They'll go to the election. You're the lowest since June on the euro dollar. And Holtzman this morning saying, look, this is the Austrian central banker, that a December rate cut is possible. So it's not just trade, tariffs, but it's now political angst imbued in the euro.
Yeah, the political economy, Mark McCormick also likes to talk about a lot. Political economy at this point is almost more important than central bank policies. We also have Bitcoin. I put this in here. Lisa and John away. Anne-Marie will play. Bitcoin, a record. This is part of the Trump trade.
This emphasizes the power of stories and our collective imagination for the greatness the future brings. I mean, of course, crypto was such a big part of Trump's campaign, really courting the crypto audience, going to different conferences. But this is the thing, and Terry Haynes pointed this out, that there's no bipartisan coalescing on how to actually approach Bitcoin and how to regulate crypto. There's nothing clear on it at this moment. So this is an asset that really encapsulates so well what we can do with hope for the future. It's the same thing that's happening to small caps right now.
It's the personification. It's literally the personification of deregulation. When you think what the crypto world actually spent in this election, not only did their wealth increase if you look at Rich Go, but also you just look at the crypto world spent $200 million on political action committees. So this is a just reward for now. You just look at Coinbase this morning, they are powering ahead, the cryptocurrencies. And of course, there was a bit of de-risking going into the election on crypto.
I always felt like crypto had hit the top during COVID when my mom decided to get a wallet.
I wondered where you're going to bring up, Mom.
Yeah, and she decided to get a wallet. She forgot it existed. And over the weekend, she's like, you got to see my Bitcoin because the Trump trade. She completely forgot. She was just playing around. It's not enough, for disclosures. But
she got the password.
She's got the password, unlike Matt Miller. She knows where it is. All right, under surveillance this morning. President Biden set to host President-elect Donald Trump at the White House on Wednesday. Biden committing to a peaceful transfer of power in a recent speech. It will be the first such meeting since 2016 after Trump did not invite Biden to meet after the 2020 election. So Biden is really giving the grace for the president-elect Trump, something Trump did not do for Biden, to be a fly on the wall, Danny, of this meeting.
Well, we know some of the reports suggest that one of the topics that will be discussed is Ukraine and the importance for the U.S. to continue to support Ukraine and have that funding there. But we were just speaking with Morgan Ortgaus, former State Department spokesperson, who said that the focus for the Trump administration will be ending the hot wars to concentrate on China. It's not clear just how receptive a Trump and a Trump team might be to Biden's call to say, hey, you need to continue to support Ukraine.
And also Washington Post over the weekend saying that Putin and President-elect Trump had a phone conversation. Now, I spoke to a foreign policy expert who said, look, these phone conversations are not illegal, but if it starts to veer into conducting foreign policy, that could be a problem. But what you're seeing, this individual said, is raw political power taking place. It's completely shifted downstream from Washington, D.C. to Mar-a-Lago. Also, speaking of political power, German Chancellor Olaf Scholz is open to speeding up the country's early election to as soon as February. Scholz said he has no problem moving up a confidence vote in Parliament ahead of Christmas. Polls currently show Scholz's conservative opponent leading in the race. So Germany is about to get a new government, and they have a lot they're going to be reckoning with.
Yeah, I mean, Scholz thought that he might be able to play for a little bit more time here, that he would be able to play through until March, but it looks like he's going to push up that no confidence vote in himself so that they can accelerate the voting process. And you also got to think about the bigger issue for Europe. You just listened to Ursula von der Leyen over the weekend on her first engagement with the president-elect Donald Trump, talking about buying American LNG relative to Russian LNG. And then you get these other narratives coming out of Russia going, are you really prepared to pay 40% more? So already Trump and Europe are talking about what it is that he expects them to do more of. And of course, Scholz is very different to Angela Merkel. Angela Merkel was in power during the first Trump regime. So Europe lacks that kind of iconic leadership going into the 47th President-elect Donald Trump's term.
Well, you could argue maybe it's Meloni this time around. And she and Trump have a great relationship. When it comes to Scholz, he didn't have that leadership because his government was falling apart. And that's part of the bid to hold this election, this vote of confidence in December. But it only moves the timeline up by a month. He'll only be able to hold an election in February instead of March. We're already going to have a month of Trump at that point. We're already going to have actions being taken on tariffs. He said he's wanted to do a lot of these things aggressively on day one. So what does it look like to have a lame duck session in Germany, potential infighting with other minority parties trying to come up and take power, when Anne-Marie, as you started out with, so rightly so much for Germany, so many headwinds that they need to grapple with.
They're getting dumped on when it comes to China, and they're having to put up those tariff walls, and potentially they're going to have issues when it comes to President-elect Trump. Oliver Crook this morning put it brilliantly. He said he just got back from Brussels. Everyone was running around Brussels saying, we're ready to make a deal with Donald Trump. We're ready to make a deal with Donald Trump. Maybe why Ursula von der Leyen is finally willing to maybe buy even more natural gas from the United States. But then Oliver Crook said, is Donald Trump willing to make a deal with you? And that remains to be seen. All right, moving on to the Fed. They're going to be looking at the policies coming out of Trump next year. Minneapolis Fed President Neel Kashkari saying the Fed may hold off on further rate cuts due to lingering inflation. Kashkari also said uncertainty is high heading into a new presidential administration. Fed Chair Jay Powell is also due to speak on Thursday. Man, it's a ton of Fed speak this week, and they're all going to be asked the same question. How do you make policy when you don't know what is going to be coming out of Washington next year?
I think this goes to the question of what kind of models are you running? Are you running extreme models of perhaps some of the most extreme policy narrative that's been put out there? What would 60% on Chinese imports into the United States really look like in terms of the inflation narrative, in terms of the growth narrative? And then, of course, it's not just those tariffs, it's whether the rest of the world responds to the United States of America, and to what extent can that impact the growth narrative here? The more extreme the response mechanism from the rest of the world, the bigger the drag on growth and higher inflation that you look at here. Kashkari talks about tariffs, and he said it'll come from tit-for-tat tariffs. That's a very, very expensive assumption, in that, you know, if you're going to level 20, 30, 60% in tariffs to your enemies, what would you do to your allies? You know, where do your allies fall in that narrative?
Kashkari did give himself an out, though. I think this was subtle, but his tone changed. He said it depends on a lot of things. But the other thing, just in him saying that inflation is not vanquished, he gave himself an out if the Fed next year is not only pausing but hiking. Recall September 23rd. He said that the balance of risk had shifted away from higher inflation and towards the risk of a further weakening of the labor market. This is not a Kashkari that was talking about labor market risk. He was talking about inflationary risk.
All right, and we'll see who else maybe is going to be shifting their tone this week. It's a busy week of data and Fed speak ahead. U.S. CPI data on Wednesday, followed by PPI and comments from Fed Chair Jay Powell on Thursday. Nela Richardson of ADP joins us now. She's looking forward to all of this and maybe also playing a little bit of scenario analysis when it comes to 2025. Let's just start the week off. What are you looking most forward to?
You know, I'm looking at CPI because it's going to be so important for how the Fed conducts itself over the remainder of 2024. But I think the sleeper of the week is initial jobless claims. Here's why. We saw a really negative private sector print from the BLS for October. So we should see some indication in this high frequency data that companies are laying off. We haven't yet. It's still super low, and that's an indication that the BLS number may be revised higher, or that the labor market looks a bit stronger than that last report would suggest.
It's a really good point. It was the government sector that added to jobs last time around. Right. So in this scenario where you don't see that coming through, can we also go back to this thing of, okay, the last month's data, it was all weird. It was hurricanes, it was strikes. We basically have to discount it all.
I think there are some threads that we can hang our hats on. This very low initial jobless claims number that's high frequency is one of them. We're seeing strength in the labor market at ADP. There was hiring in the JOLTS report also coming out of BLS. So there are some hangers we can use, but definitely we want to look towards the future to see if there's evidence of weakness. And then coming back to that CPI print, super important, looking at services and the role that labor market will play in pushing up or restraining service sector inflation going forward. That's going to be very important.
Well, in the spirit of looking forward, it's a 2025 where the outlook is just so uncertain. We don't have any great economic models for what adding 7 3/4 into the U.S. deficit will mean. Does the Fed need to start talking about scenarios? Do they need to start laying out different futures that they might face? Or should they continue with the line, we need to wait and see?
I think the Fed is always looking at scenarios. So I don't think this is a net new policy. I mean, they have 400 economists. They have to do something with their time. So I think scenario analysis
I thought it was the easiest job in Washington. You flip a coin.
Come in and flick a coin, off you go.
Scenario analysis is built hardcore into their policy framework. What I think it's going to be very important for a data-dependent Fed is to have a consistent framework. And that's the task of the next few months, is to reevaluate that time framework. It's time. The last time they revisited it was in 2020. It was a different inflation picture then. Now they have to kind of rejigger that framework to fit the scenario that they're in right now. This idea that inflation may bounce back, it might be a little bumpy, and that trajectory is very different than too low inflation, what we had going into the pandemic.
Look, the narrative around tariffs, we will know incrementally, you know, whether it's 20%, 30%, and that could be on your allies, not your enemies. On your enemies or perceived enemies, it's China's 60%. Currently, it's 2% on the trade-weighted assets that are imported into the United States of America. That is going to go potentially to 20% of the imports into the United States of America. Extrapolate that for me in terms of potential inflation, but more so the drag on growth.
Right. So the U.S. has benefited in this soft landing outlook that it looks like we're still on that trajectory from a very steady global picture. The IMF has called the global economy underwhelming but steady.
Yeah.
So it's not been a headwind. It hasn't been a tailwind. Tariffs could change that a bit, whether global growth becomes, in fact, a tailwind or a headwind in the short term versus the medium term versus the long term. Those are all scenarios that have to be penciled in. But it's really important that people remember that the administration during the first Trump term had a product out of list, a product exclusion list.
Yes.
It wasn't just across-the-board tariffs. The carve-outs matter, and they'll continue to matter as we go to these bigger, more macro tariff policy implementations. What's on that list? And until we know what the product exclusion list looks like, we can't really handicap what's going to happen with the economy.
And I saw some pretty good articles over the weekend talking about Canada and obviously the amount of energy that's imported from Canada. You know, and again, that would be one of your closest allies. It's certainly one of your closest trading partners. As you look at the fiscal kind of narrative, and this was one of the big stories and one of the big things that we wrote about going into the election under Harris, it was going to be just under $4 trillion under Donald Trump. If everybody gets a tax cut, literally, you get a tax cut, you get a tax cut, you get a tax cut. I can't remember where that came from. I think it was Maya McGinnis and yourself. But on a slightly more serious note, that is a deficit of $7.75 trillion. We're not going to get everything that he promised, are we? Again, you talk about the carve-outs, but it's also about what he's going to have to walk back from a tax perspective.
You know, what's said on the campaign trail and was actually done in D.C. as someone who spent almost 20 years in D.C. And several of those years as a government economist, like trying to translate that policy into legislation, into law, they're very different things. The sausage making is real, democracy is hard, and putting it all together means that what you say and what actually is done is very different. That being said, you know, when you look at the big picture, whoever, you know, the path forward is with a very stable U.S. economy. But the big dragon, it's not even an elephant anymore. The big dragon in the room is the fiscal deficit. No one talked about that on the campaign trail. It was not a political issue. Nobody wants to talk about it because it's such a big dragon to slay. And so that's a problem not just in the United States, it's a problem throughout the world. And it is a problem that could reignite inflation by crowding out investment and crowding out the ease of capital allocation to other parts of the world, which leads to a below a capacity productivity, which lowers growth. So it is an issue.
Paying off your debts doesn't win elections. Could we potentially, though,
but it wins economies, so there is a tension there.
Could we maybe be on the downward trajectory of this idea, then, of U.S. exceptionalism?
I don't think we're there. I think there is plenty in the U.S. that keeps the strong growth narrative alive. But we can't take it for granted. Productivity is lower now than it was going into the pandemic. That's worker productivity. And the way this country grows, the way it's always grown, is when there are more workers and those workers become more productive. And we know that there's plenty of technology out there that could make the U.S. worker more productive. The question is, will it get translated through the capital markets into the companies, especially the small and medium enterprises that need to see that productivity enhancement with their workforce? That's a big open question. And also the interest rates we have to pay to move that capital is a big open question, and fiscal debt could affect those rates.
The real sausage making. Washington and the financial markets. Nela Richardson of ADP and also Bloomberg contributor, thank you so much for joining us this morning. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Yahira Hackes. Hey, Yahira.
Hi, Anne-Marie. Japan's Prime Minister Shigeru Ishiba will stay in office after winning a runoff election. While Ishiba failed to gain a majority of the votes, he did win a plurality in the runoff to prevail against his main opposition party leader. Despite the win, his future as prime minister is uncertain due to his coalition's weakened position. Plus, he may need to make concessions to opposing parties in order to pass legislation. Ishiba is expected to meet with U.S. President-elect Donald Trump later this month. Meanwhile, here in the U.S., President-elect Donald Trump has chosen Tom Homan as his so-called border czar. Homan previously served as the acting head of the Immigration and Customs Enforcement Agency. In a post on Truth Social, Trump said Homan will oversee immigration, maritime, and aviation security and be in charge of all deportations of illegal aliens. And firefighters continue battling a major wildfire in New York and New Jersey. The rain overnight is offering some relief. The deadly blaze started last week and set over 2,500 acres between the New York-New Jersey border on fire. This coming amid the worst drought in the Northeast in 22 years, with 94% of the region listed as abnormally dry or experiencing a drought. That's your Bloomberg Brief. Anne-Marie?
Thanks, Yahira. I was so excited this morning when I woke up and actually saw it was raining outside, devastating these fires, really scary. And also, I don't know if you guys smelled it, I could smell it in New York.
Yeah. Not only could I smell it, I could see it. You just look uptown and you saw the fog coming from New Jersey. There are apparently fires in Prospect Park. I think for people, this is starting to hit home that this is a problem that can't be ignored.
Yeah, we definitely wish those firefighters good luck.
Yeah, I mean, definitely. I mean, you just think of this autumn relative to last year. It's a historic drought this time around this year. And we're just seeing on one of the lines, it's not only the fire burning on top of the ground, it's burning under the ground. That's according to the New Jersey Fire Service Chief on the line this morning.
Yeah, scary stuff. We'll keep you posted on all of that. Up next, though, this morning, trade under Trump.
I think you'll see an escalation because remember, these new tariffs are on top of the ones that the Trump and Biden administration put in. It's not just we're back to Trump's tariffs.
Potential trade wars 2.0. That's coming up next. You're watching Bloomberg Surveillance. Good morning. Under surveillance, trade under Trump.
I think you'll see an escalation because remember, these new tariffs are on top of the ones that the Trump and Biden administration put in. It's not just we're back to Trump's tariffs. Biden never took them away, and they'll be talking about adding on to those. When a country like China is so good at manufacturing, very hard for businesses to avoid using that.
Here's the latest. President-elect Donald Trump proposing 60% tariffs on products from China and between 10 and 20% on all foreign goods, sparking retailer concerns. Sucharita, Kodali of Forrester writing that the truth is the U.S. manufacturing has been gradually moving away from China for years now. Mexico has been growing, and that is likely something that makes the most sense for everyone. Sucharita joins us now. Thank you so much, Sucharita, for joining us this Monday morning. Especially we have personnel, potentially announcements when it comes to the Trump 2.0 administration and what that might mean for tariffs. When it comes to tariffs in the second iteration of Trump, is this a negotiating tactic, or do you think there's going to be across the board blanket tariffs?
Well, it's really, really hard to tell. I mean, it is true that there were some more tariffs in the first Trump administration on categories ranging from steel to washing machines to solar panels. The truth is that they weren't as broad spread as they were claimed to be. So the question is this going to be like another border wall where there was a lot of saber rattling in the election, but the actual execution was far less? Or is it going to be like abortion rights, where there were promises made and there were promises kept? So I think that there is a lot that remains to be seen. There will likely be some more tariffs. But the truth is also that there is a reason that a number of business executives called to congratulate Trump right after, because they have a very, very vested interest in trying to reduce the number of proposed tariffs.
Well, for that uncertainty, Sucharita, there have been a lot of reporting that some of these businesses, retailers had pulled forward their demands, not just, of course, tariff strikes as well. Where do retailers then stand on the ability to weather at least some tariffs, and where do inventories stand?
Well, this has been an issue for the last several years. So what we started to see was gradual movement away from China, where companies were diversifying their manufacturing base, either in the Far East or in some cases in North America and South America as well. So we have started to see that, and any company that has not already started to move at least some of their production to other regions of the world is probably either in denial or they may not have a risk mitigation and security strategy that they probably should be having in place. And I would question whether that management team is really doing what they need to do. So we've gradually been seeing that. And at this point, we have less and less production that is in China. And really what some of the per the earlier quote, there are economies that we could probably bolster in this region, like Mexico. And that would not only support some of the immigration and border issues, but it would also support some of the challenges with just the length of time that it often takes to get imports from the Far East anyway. And it is also something that that many of these U.S. businesses and U.S. consumers could also benefit if they could get to some levels of building out some of that manufacturing infrastructure.
Well, we've already seen some removal of production from China into India for Apple. But the next most important policy that we'll get a little bit more clarity on next year is the tax rate for bring it back to America, build it here in the United States of America. Now, we don't know many of the details on that, who will qualify for that, who will not qualify for that, but a lot of that is assumed to be around manufacturing. Is that a 3-5-year maneuver for industry and manufacturing rather than a very short-term response?
Well, these are all things that are still highly, highly speculative. So it's hard to know what exactly the impact is going to be, the timing of the impact, and even which products are going to be affected. Certainly, and when we're looking at the retail industry, there are still sectors like, for instance, the toy industry. That is a sector that has not really diversified outside of China. And that's going to absolutely be impacted. And that is a sector that has been challenged for a number of decades that even long preceded tariffs. So there are certain sectors that will be, and then there are others that have been diversifying for some time and will likely be well insulated.
Sucharita, thank you so much for your time this morning. Sucharita, Kodali of Forrester Research. Coming up next, Chris Harvey of Wells Fargo, Henrietta Treyz of Veda Partners, and the former Obama economic advisor, Jason Furman. That's coming up next. This is Bloomberg Surveillance on Bloomberg TV.
The rate path overall will have to be slightly higher than what the Fed had penciled in.
We are a distance away from what the neutral rate is.
The Fed, I think, has overestimated how tight they are already and underestimated the strength of the U.S. economy.
By the Fed's own admission, there are upside risks to inflation.
The uptrend in yields that started with the Fed cut in mid-September, I think is very much intact.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning from New York City to our audience worldwide. This is Bloomberg Surveillance. Today, alongside Danny Berger and Manus Cranny, Lisa Abramowitz is on assignment and John Ferro taking the day off. He did nearly 30 hours on TV last week, so much needed. But we're holding down the fort. And the Trump trade continues on the Trump train. You see these markets continually pricing in the policies President-elect Donald Trump has been talking about, especially when it comes to small caps. And on Friday, we had the S&P 500 hit another record, notching another record for 2024. The question I continuously have is how are these markets continuously pricing in things like tax cuts, especially a corporate tax rate of 15%, when we still don't know if the Republicans actually won the House of Representatives. There's more than a dozen seats that have yet to be called. But the market's, Danny, pricing in a trifecta.
Because it's all vibes now. Nothing matters. It's all good vibes. It's the animal spirits reawakened. But yes, you're right. It's the 50th all-time high this year. Torsten Slok of Apollo just out with a note saying that on average, this market usually only does 18 all-time highs a year. It speaks to the fact that even before this election, even before Donald Trump reawoken the animal spirits, it was a pretty bullish market. We only had 3 recently, maybe, from the Trump election. But the fact that we can keep going higher, even though equities ran up into the election, really shows you just the sentiment and bullishness of this very moment.
You're going to hear a whole raft of people sending the notes in terms of where's the valuation, 22.5 times forward earnings. You talk about the equity risk premium in these markets, the excess equity risk premium, the risk-free rate is the lowest in 22 years. And this goes back to the drum that was being banged around this desk all last week, which was at what point, and the cash bond markets are closed, but at what point do the bond yields actually begin to challenge your equity allocation? We're not there yet, and some people are talking about 5% on yields.
Right. And a lot of that depends on what the Fed does.
Of course it does, along with fiscal policy and tax.
And we're going to hear from a lot of Fed speakers this week. Neil Kashkari of the weekend. I don't know, Danny. I feel like he was pouring a little bit of cold water on maybe December. Maybe they need to look through. He said we're not done yet when it comes to the inflation target.
I agree with you. I think this is more notable than a lot of us realize. The fact that his tone has changed. The fact that he said we need to have confidence that inflation is going back to 2%. Last time he spoke in September, he sounded like he had that confidence. Not even the confidence, but the labor market was his top priority. The risk of a further weakening labor market. He did not talk about that this time. Has the Fed changed its tone? Maybe not away from an easing bias, but to a pausing bias.
And we're getting a lot of personnel. And I always say in Washington, personnel dictates policy. You can tell what President-elect Donald Trump is thinking depending on who he puts in these positions. We still don't have the Treasury Secretary.
We don't, but then you and I touched on this morning. There's a fresh piece out from Bloomberg, and who's there? Howard Lutnick, we know, is corralling the various personnel. Could he be one of them? But the betting markets, and I think you said this, 80-odd% on Scott Bessent. And when it comes to choosing the various names that are going to be in Treasury and in financial positions, I've chatted to people at State Street. They said, these are really professional people from Wall Street who know how to run numbers, who know how to think. What do markets what will they take away from various policies?
Well, the prediction markets got Trump 2.0 accurate. They said he was going to win. Potentially with Scott Bessent, this is a market endorsement of maybe what market participants want to see when it comes to the Treasury. All right, coming up on the program, Chris Harvey of Wells Fargo as the S&P 500 hits its 50th record high this year. Former Obama economic advisor Jason Furman on what risks Trump tariffs pose to the economy, and former Chicago Fed President Charles Evans on the Fed's policy recalibration. We begin this hour with stocks higher, as investors will see room to run even as the Trump trade is aggressively priced in. Chris Harvey of Wells Fargo saying this: Fed accommodation and Tuesday's election results are bullish as Republicans likely achieved a red sweep, which is seen as pro-growth. The Fed decision was in line and third quarter earnings have been mostly constructive. Chris joins us now. And Chris, hats off to you because you had a lot of this in terms of your research talking about what a Trump 2.0 would look like and what that would bleed into in terms of where it means to the market. I can't get my head around that. The markets are already pricing in this trifecta, yet we still don't know the composition of the House of Representatives.
Yeah, if you go back to the betting markets, right, the betting markets really did have it right. And if you look at where the betting markets are, they are saying it's a red sweep. And if you look at the odds, it is indicating it's a pretty tough odds for the Dems to really take the House. And so we're playing with the red sweep. That's small caps, that's pro-cyclical, that's local over international, and that's really what you're seeing play out. And I'm just going to play off of something you also said. If you think about what's happening, people are policy. And if you go to SEC, FDIC, OCC, he's got a lot of room to play with. And many of these people are either their terms are expired or they're just waiting for the next person. And so he's going to have a lot of opportunity to put people people are asking us where that deregulation comes from, and it comes from those people. That's the first step, right?
Chris, it's also really interesting to hear you and so many of your peers talk about these betting markets. Right. And Anne-Marie mentioned this, just how right they got it called. And the market moving in lockstep, really heading into the election with the betting markets. Yeah. Is this just a new thing we're all going to pay attention to? Are betting markets going to be a thing that can move equity markets, that can move bond markets?
I think they will move in tandem. I think they were much more predictive than the polls. They were much more helpful. They're very granular, and I don't think they're going away. I think this is the last time that you see an election without a big influence from the betting markets, right? And do they interact and do they play off of each other? Yes, which is also a little bit of a concern because there is a type of momentum that could develop and get things really wrong in the future.
That's a really interesting point. So how do you position, if you're just a day-to-day trader or even long-term, do you need to have one eye on the betting market and be positioning as such?
Yeah, because a lot of times in the equity markets or just in the capital markets, it's not so much about actual, it's about the perception, right? And if the perception's swinging one way until you actually know the answer, well, that is the answer, right? And it's not, we talk about perception becoming reality here, it won't, but in the short term, it is. And so you really do have to pay attention to it, you're right.
Well, there's two markets this morning that not just this morning, Bitcoin is flying higher, but also at the same time, I look at banks, and BI have run the narrative here. It's about changing the status quo in terms of what the end game for Basel III is. So if the leg up into this election was NIMS, then I'm just looking at what Mike Mayo is talking about, veteran analyst here. He says he's expecting a paradigm shift for banks.
Right. So Mike and I talk a lot, and one of the things that we've had is we've had 15 years of upward regulatory pressure, right? That peak last year, in the last 12 months, you had Basel III being watered down a little bit, you had the Chevron decision, and now, as we were talking about before, the first thing you're going to have is different people in places of power. So again, policy is personnel, different personnel, and what you're going to see is you're going to see multiples, and this is what's occurring right now, multiples will begin to expand, but then we're going to have more M&A, more IPOs, more trading, and the capital markets, these really starts to expand as well.
And it's going to be, we can ring a bell on banker bonuses and maybe even on dividends and buybacks, let's be fair. Just give something to everybody. We talk about a paradigm shift in banks, but in all seriousness, we look at Bitcoin this morning. Going into this election, gold took on a whole new euphoric level of its own. You look at deregulation, you look at crypto, and people begin to talk about alt dollar assets and a new challenge. How do you look at that kind of asset? Because it has been given a certain amount of credibility this year with ETFs, et cetera.
So Manus, I have to plead a little bit of ignorance. So gold and crypto, not in my wheelhouse, but what I would say is what I think is going on is partially one, the environment is becoming more hospitable to crypto and it is becoming institutionalized. The other thing that's happening is that when you look at government and government balance sheets, not so great, right? And people are talking about fiat currencies and pressure on governments. Well, where would you go? Well, if I'm less than 40 years old, I go in the crypto market. If I'm more than 40 years old, I go in the gold market. Right?
Do you think that there will be a day? And find the path. Make sure that you write down your password and keep it somewhere safe. Because I have no memory. But when it comes to your world specifically, I'm looking at this equity risk premium number, and it's low. Right. It's the lowest in 22 years over the risk-free asset. Now, last week around this table, they talked about the screaming bond markets. Right. But here we are trying to assess equity risk premium and whether it's just too tight now to step in at these all-time highs.
Yeah, so we have almost a 22 multiple, and we're still below the market. We were high in the street earlier this year. We're not high in the street now. We're over 5,800, and again, we're still below the market. We can push up that multiple, but it's just, you're right, it's just not justified at this point in time, which is why we keep pushing down to mid cap and small cap. That's where the valuation is, that's where the opportunity is, that's where you can see multiples expand, right? I can't justify it. Does that mean that things are going to come crashing down in large cap space? No. It just means that I find better value down that capitalization. That's where we're putting our attention. That's where we think the alpha is, and that's where we think the opportunity is.
So small cap's up 9% in just the past week, highest level since November of 2021. What sort of earnings do we need to see to justify that?
So I think we need to see pretty good earnings. What we need to see, and what we saw during earnings season is bad news still bad news? And the answer is yes, but not as severely as it was. And what you're also seeing is, if we go to 2025, GDP numbers are less than 2%. We saw something like this at the beginning of the year. At the beginning of the year, GDP numbers were 1.3. They ended up in April at 2.4, 2.5, and during that time period, small caps also went up about 9% as well. Right? They outperformed a little bit, but here I think they will also continue to outperform because what we're going to find out is growth going forward is much stronger than people is really underappreciated, and that's really positive for small caps.
You're pricing in, though, and the market's pricing in all the good things of a Trump trade. What about the tariffs?
Yep, tariffs. So that's a great question because what is Trump's motivation? Is he trying to bring people to the table or is he trying to bring revenue in? Because one thing that we think about, right, that maybe what they want to do, if it's to bring in revenue, right, everyone uses Amazon. If you know Amazon, Airbnb, eBay, what do? It's a seller's marketplace, right? You are charged a fee for selling your goods there. Well, what you want to do to the American people, and you do have a red sweep, you start saying, hey, we're the biggest market in the entire world. There is a fee for doing business here. You don't want to pay that fee, that's fine, right? Maybe that fee is 2%, 3%, 5%, 10%, right? But there's a fee for using our infrastructure, for accessing our people. And I think that's a great way to sell it to the people and to think about this and a great narrative. It's also a good way to raise money. But if your goal is to really negotiate and really get the people to come to the table, well, that doesn't work. And you really do want to talk about much higher tariffs. The question is, and we really don't know at this point in time, is it for negotiation? Is it for revenue? Or is it a little bit of both?
Circling full circle, personnel is policy.
Yep.
When you look at who's going to be the top post at the Treasury,
Right.
the betting markets have Scott Bessent about 80%.
Right.
Robert Lighthizer name has also been in the mix.
Yeah.
On the betting markets, though, he's about 2%. Is that the market's wishful thinking that someone that is antagonistic towards China and is really the brain trust when it comes to tariffs in Trump world could maybe get the top post at Treasury?
Yeah, so again, it's another area I don't have a ton of expertise. It is interesting that you see this, and this is what the market are beginning to think about and talk about and react to.
I guess another way of saying that is if Lighthizer was to be at the Treasury,
Right.
would that be market negative?
Hard to say. Really hard for me to say, right? What's going to be market negative if Trump comes out and he does institute right away these tariffs and he's very aggressive about it, and we do go to these levels, because that's going to put a ton of stress in the marketplace. That's going to put a lot of uncertainty into investors' mind, and that's going to really upset the apple cart. And you should see some sort of reaction function to that, and that's not going to be real positive because people just won't know how to play it.
Right. So the market might push back on some of Trump's potential policy proposals.
I think so.
All right. Chris Harvey, thank you so much for joining us. Chris Harvey as Wells Fargo. Let's get an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Kakis. Hey, Yahira.
Hi, Emery. President-elect Donald Trump announcing key figures who will not be part of his administration when he returns to the White House. Trump said Nikki Haley, who served as U.S. ambassador to the UN in his first term and then ran against Trump for the Republican nomination this cycle, will not be invited back. Neither will Mike Pompeo, who was both Secretary of State and CIA Director in Trump's first term. Meanwhile, German Chancellor Olaf Scholz is open to moving up a parliamentary confidence vote to before Christmas, potentially speeding up the country's early election to February. Scholz's government collapsed last week after he fired the country's finance minister, though the chancellor expressed confidence that he can win the election despite polls suggesting his opponent is the front runner. And China's trade surplus is on track to hit a record high this year, potentially reaching almost $1 trillion ahead of Donald Trump's return to the White House. The country's export prices are falling, and it is relying more on exports to make up for weak domestic demand that Beijing has only recently tried to address through stimulus. The growing trade surplus is generating pushback from other countries, including the U.S., and may lead to tariffs and a currency war. That's your Bloomberg Brief. Anne-Marie?
Thanks, Yahira. Up next, closing in on a red sweep.
We have got to change the way the Senate is run to get Trump's agenda done. We've got to get, for a lot of things, 60 votes in the Senate. So we've got to have somebody that's going to sit down with Democrats.
That's next. Speaking of the betting markets, Rick Scott rising as his chances maybe to be the Senate Majority Leader. You're watching Bloomberg Surveillance. Good Monday morning, just after 7 a.m. here in New York City. Anne-Marie Hordern alongside Danny Berger and Manus Cranny. Lisa and John are both not in today. John taking much needed rest. Lisa will be bringing us some interviews from Peru over the course of the next few days. This morning, you have S&P 500 futures up 0.3%. S&P 500 secured another record, 50 all-time high. Danny brought up the fact that Torsten Slok's talking about you'll usually only get 18 all-time highs when it comes to maybe a normal year. 2024 has been anything but normal. We're seeing a ton of dollar strength, and you can see that on the euro, the lowest since June, 1.0662. So a weaker euro against a stronger U.S. dollar across the G10 as the Trump trade on the Trump train continues. All of that also depending on whether or not we get a trifecta under surveillance this morning, closing in on a red sweep.
We have got to change the way the Senate is run to get Trump's agenda done. What it's going to take is somebody who's going to take the time to sit down and bring people together. We've got to get, for a lot of things, 60 votes in the Senate. So we've got to have somebody that's going to sit down with Democrats and say, how do we balance a budget? How do we do these things? Okay. That's all I've done. I'm a deal guy.
Here's the latest. Senate Republicans preparing to vote for a new majority leader. Senators Rick Scott, John Cornyn, and John Thune all vying for the job. Control of the House still up for grabs with 18 races yet to be called, almost a week out from the presidential election. The GOP currently maintaining its lead with 214 seats. Henrietta Treyz of Veda Partners writing, should Republicans take the House in the days ahead, they will secure the ability to enact a fiscal year budget and unlock the reconciliation authority needed to pass legislation with 218 votes in the House and a 51 in the Senate. Henrietta joins us now. Henrietta, before we get into the Senate, I want to start in the House because we still don't know the makeup exactly, but the Republicans do seem poised to take control. There is one hiccup. We have overnight that Elise Stefanik, the Congresswoman of New York, likely will be joining the administration. She was nominated to be the new UN ambassador. So now the Republicans are going to have to, get another Republican in that seat? How hard is that going to be?
Yeah, they need a couple of Republicans on the House side, and then I expect quite a bit of changeover on the Senate side as well, with key senators going up to the White House, whether that's Bill Hagerty or Marsha Blackburn, Marco Rubio. Obviously, J.D. Vance is already going as well. So there's going to be a lot of state-level decision-making to put more Republicans in those seats, new freshman Republicans, for those races on the House and Senate side.
You say the Republicans can also theoretically use reconciliation twice next year. How could they do that?
Right. So the whole process walks through the budget reconciliation instruction. They have 2 fiscal years to work with, 2025, since next year will be in 2025, and we do not have a budget enacted for that year. And then also 2026, which will start right after we finish 2025 and whatever reconciliation bill they end up passing. This is the exact same playbook that we ran in 2017, where you had reconciliation available for healthcare under the fiscal year 16 budget and then taxes under fiscal year 17 budget.
Even so, 2017, Henrietta, was a good example that even if you have a majority, it doesn't mean that you have control. You had infighting amongst the Republicans that meant certain legislation of Trump that he wanted couldn't be passed. Do you understand the willpower and the cohesion of Republicans this time around to pass Trump's top priorities?
Yeah, and Anne-Marie started with the House, and I think that's really smart. The majority that Republicans are going to be operating with in the House is going to be as few as 2 seats. 220 seats now look relatively safe. That's a bare minimum. That's even worse than the majority they have now. And we've seen the struggle that Speaker Johnson has gone through just to keep the government open. So passing this tax bill next year, there's a sense on the street that this is all going to happen quickly. It's going to be easy. Everybody's going to come together. We're talking $1.2 trillion from coastal states via the SALT deduction. That is the path that Republicans have to the majority in the House. It goes straight through California and New York. So you're going to immediately upset that apple cart. And then you have another, roughly $1 trillion coming from repealing the green energy tax credits. 70% of that funding is going to red states and job creation in those districts. That's going to be really hard for lawmakers to enact next year. I expect that they will tether it to the debt ceiling, which is also something you can do via reconciliation. And that's maybe the best way to pull forward the bill. They pass it in July when the debt ceiling comes due. But otherwise, it's going to take all the way until December. And tariffs will be on very quickly, I'm expecting.
Henrietta, good morning. There's multiple things to trip over next year, which is going to make it a difficult year. Part of the debate this morning around the desk is to whether Robert Lighthizer makes a comeback. The FT says yes, Reuters says no. So there's a lot of debate. The betting markets has it a low-pegged risk. Scott Bessent as Treasury. What is the most aggressive, underestimated thing in the in market perspective? Is it that Lighthizer comes back at Treasury, or Lighthizer comes back as Treyz are?
Yeah, I think Treyz is more realistic. I don't see Ambassador Lighthizer being a Treasury Secretary. Scott Bessent is obviously traveling the street to try to get that job now, and I expect he would be more likely, especially in a confirmable Senate seat. The benefit for Lighthizer in being some sort of elusive or roving trade czar is that he could oversee the expansion that's gone on at USTR and the Department of Commerce, which has a tremendous amount of authority over tariffs. So I expect Lighthizer to be something in the sort of upper echelon, but not necessarily a cabinet post, something new that would really speak to how critical tariffs are as a part of the president-elect's foreign policy, domestic revenue, and trade policy agenda. I mean, this is if anything was a referendum this election cycle, is that Americans are supportive of Trump's agenda on tariffs. And I think Bob Lighthizer is the most competent person to run that strategy. So immediately calling China out in violation of the phase one trade deal that they negotiated in 2020 is the first thing I think will happen. And I don't think anybody should sleep on the potential for EU auto tariffs in the end of March.
When it comes to cabinet picks, of course, they need to go through Senate confirmation hearings. I was stunned basically over the weekend. Rick Scott surging now, the senator from Florida, when it comes to maybe becoming majority leader. And Donald Trump on his Truth is showing the poly market of Rick Scott surging. Do you think he has a big chance now to beat out the Johns?
No, I don't. This is a secret ballot, so all that stuff can sort of happen in the ether, and Rubio and Haggerty can speak to supporting Scott, which I think endears them to the Trump administration. But at the end of the day, all these senators are going to go into a room, and it's a secret ballot. And I think that Rick Scott will maybe get 12 votes, which is 2 higher than he got last time around. But one of the Johns will win. Staff expects that it's more likely to be John Thune.
All right, Henrietta, Treyz, thank you so much for your time this morning of Veda Partners. A lot really to dig through there. Man, I think that's the right question, though. Where does Robert Lighthizer go? His name is being floated for Treasury Secretary. The Financial Times talking about maybe just taking on this czar program, direct tariffs out of the West Wing, or does he go back to USTR?
I think this goes back to something that Danny and I chatted last week, which was dollar Mexican. On the day of the election, crash bang wallop went the Mexican. Then there was reprieve the next day. And then as soon as Lighthizer's name came up in that FT article or on Friday afternoon, this thing whipped around again. And I think it is Mexico that's ground zero, not just for the politics of what this administration does with China, but also in terms of its relationship with the United States of America. And it's on a sticky wicket.
But the fact that Trump is looking at these prediction markets to see where they're going, Emery, I think that's the fascinating thing. How much is he going to be moved by thinking, this is what Wall Street wants, this is what assets want, I want to be seen as the president that does well for them, and I'll follow where prediction markets go.
And what if he does what markets are not predicting? Like Treasury Secretary right now, Scott Bessent, far and ahead, the lead. Maybe if he doesn't get that post, what happens next? We'll have to wait and see. Coming up in the program, maybe some more insight. Former Obama economic advisor Jason Furman will be joining us. You're watching Bloomberg Surveillance on Bloomberg TV. Good morning and happy Monday. Welcome to Bloomberg Surveillance. I'm alongside Danny Berger and Manus Cranny. John and Lisa are off today, but as John would say, no major drama when it comes to these equity markets this morning. Futures still higher. The S&P 500 notched a 50th all-time high. The markets seem to be doubling down on Trump 2.0. I find this fascinating given the fact that we still don't know the composition of the House. Yes, it is poised to be a trifecta, but this can mean the difference whether or not they get over the finish line of whether or not there's going to be expansion of TCJA and tax cuts, most notably for financial markets and the small caps, 15% corporate tax rate. But look across asset. We have the dollar strengthening this morning across of G10, most notably, Manus, to the euro. We're all going to be traveling to Europe this summer.
We're all going to be traveling to Europe this summer for sure. And they're worried about the $158 billion surplus that they have in the United States of America. So they're worried about tariffs. They're worried about the ECB helping the situation along as Germany. And this is what Kit Duke says. He talks about the euro has a problem. And it's not just on rates. It's also called Germany and France. And that takes us ever closer to the risk of parity. Tariffs, trade war, along with rates and politics.
We also have Bitcoin. We don't normally show this, but it's actually been a darling of the Trump trade.
It has, because he really went to the crypto audience and courted them and said, this is something I'm going to do as president. I'm going to be your crypto president. 82,000. We're above that, easily a record. It emphasizes the animal spirits that are in this market and our ability to have this narrative formed, even though there's nothing concrete yet. This goes back to what you say, Anne-Marie. Markets happy to trade these things, even though we don't know the makeup of the House, even though we don't know his appointments, even though there doesn't seem to be really any sort of willingness in Congress to pass legislation about crypto. Just the fact that Trump has won is enough for the animal spirits.
I think you called it earlier, vibes.
Yes.
That's what this is when it comes to from Bitcoin. And we're not showing you a bond born today because it is Veterans Day, and we wish all those military families and those veterans a happy Veterans Day, and we hope you're able to take off. Under surveillance this morning, Qatar is stepping back from its role as mediator between Israel and Hamas. The Gulf states saying efforts have stalled and that talks will resume when both parties, quote, show willingness and seriousness to end the war. I actually spoke to a diplomat over the weekend who's involved in this, and basically they said from all sides, the Israelis, Hamas, and the United States, no one is really willing to get this over the finish line.
No, there's a sense that we're going to go into this really period of time of where nothing really gets done. In the same vein, you've got to ask yourself, where does Trump stand? We know that he and Bibi Netanyahu had a conversation over the weekend. Netanyahu saying that they saw eye to eye. But a person in the U.S. administration said that the presence of Hamas in Doha is no longer acceptable given its repeated refusal to release even a small number of Israeli hostages. So you must ask yourself this, as you have an incoming President Trump administration. That relationship between Qatar, which has been the fulcrum of negotiation, and Hamas is something that may well splinter, and that is what you evolve towards.
You're absolutely right. And if Qatar is going to be kicking out Hamas, where do they go? They go from Doha to Tehran. And what did we hear over the weekend from Netanyahu?
Well, they're in alignment from Netanyahu and from Trump, in alignment in regards to Iran. And then it is a question of re-stepping up, let's say not just tariffs on Iran, but a much more aggressive regime in Trump 2 on Iran.
Speaking of this geopolitical realignment, the Washington Post over the weekend reporting that Donald Trump told Russian President Vladimir Putin not to escalate the war in Ukraine. Trump reportedly reminding Putin of the sizable U.S. military presence in Europe. The Kremlin denies that Trump and Putin spoke, calling the report, quote, pure fiction, and saying there are no plans for them to talk.
I mean, it's not wild to think that they would talk. An incoming president talking with world leaders, sure. If he asked Putin not to escalate in Ukraine, I'm not sure what that means at this point in the war. What does it mean not to escalate when it is a hot war and so many things have already taken shape? I think one of the big risks, and Mark Champion of Bloomberg Opinion lays this out, Trump clearly wants an agreement here. He wants the war to end. He said that it would end. He can make it end in one day. But we know that with Putin, agreements can be broken. A great example of this was in 2022. He violated a 2015 ceasefire in order to do that. So what does the agreement look like if he does reach one with Trump? Is it a settlement that would guarantee genuine security for Ukraine?
But the bigger question then is what is the compromise for NATO and for Europe? You know, you were in the room with Zelensky. You sat down with Zelensky. He said he wanted to know. He then had what's on your mind, President-elect. And here we are. We're getting closer to the end game. And what Europe is worried about is what is Ukraine forced to give up? Is it a deal on Putin's terms, or is it a deal on real agreement and let's say compromise, good compromise?
And all of this, as the New York Times over the weekend said, that Russia's military is assembling a force of 50,000 soldiers, including those North Korean troops, to go after and potentially reclaim some of the territory Ukraine got back. You have to think Putin is thinking, we want to get as much as we can now before potentially this conflict is frozen. And certainly Zelensky wants to continuously push them back. All right, speaking of Trump 2.0, Trump's next cabinet is beginning to take shape. We're getting tea leaves coming out of Mar-a-Lago. Trump saying he will nominate New York Congresswoman Elise Stefanik to serve as U.S. ambassador to the United Nations. Trump also nabbing former ICE acting head Tom Homan as his next border czar. The president-elect opting not to offer roles to first-term cabinet members Nikki Haley or Mike Pompeo. A shift there when it comes to foreign policy. He's putting some distance between himself and those in the Republican Party who want a little bit more of an isolationist approach and get away from the neoconservatives.
Yeah, I mean, look, you've got to say this cabinet is going to have a room for all parties on the bench. It's just a question of the weighting on that bench, whether between MAGA, his own family, and the vestiges of the past. The questions that we've been asking around the table this morning is to what extent Treasury and, to a certain extent, who is going to be the next Secretary of State. Look at Antony Blinken, 10, 11 trips to the Middle East. There has not been any movement there. So what kind of foreign policy are they prepared to deliver to the Middle East next year?
I will say, though, we are getting these cabinet members, these names floated quickly in comparison to last time around. I mean, if you remember in 2016, it was Martin dispute. It was Chris Christie being fired. It was disappointments because he appointed globalists to different positions. The fact that we're getting more names more quickly and there seems to be more agreement and more certainty and more Trump allies does suggest, at least for these markets, that Trump has priorities and he'll be able to get them through. Maybe that's part of what we're seeing, this animal spirit reawaken, that things are moving so much more quickly this time.
And personnel is policy, which is why I'm keenly focused on who he picks for his Treasury Secretary. The betting markets, Polymarket has overwhelmingly, they think it's going to be Scott Bessent, who runs a macro hedge fund. You have to think other names that are in the mix, like a Robert Lighthizer. What would that mean in terms of trade? Would that be market negative? Because that's a very antagonistic approach on China. I think this is a market endorsement potentially for Scott Bessent. We do know that Donald Trump right now is paying attention to Polymarket because he's tweeting about it and who he wants to be the Senate Majority Leader. But we have to wait. I think that could be one of the next few to come, and we'll see it in a truth post. Then maybe leak on Twitter. All right, plenty of data and Fed speak on deck this week, including remarks from Fed Chair Jay Powell on Thursday, just 1 week after the FOMC cut rates by another 25 basis points. Former Obama economic advisor Jason Furman writing this: monetary policy is going from very contractory to reasonably contractionary. This makes sense given that inflation risks are much lower than before, but we are still higher than recession risks. I expect another cut in December, but core PCE inflation is likely to rise, making a continued process of cuts at every meeting difficult. Jason Furman of the Harvard Kennedy School joins us now. Jason, thank you so much for your time. I know you're looking at potentially this cut in December, but give us some clues on what the heck 2025 is going to look like when policy can be vastly different that this Fed needs to recalibrate for.
Yeah, first of all, separate from anything related to policy changes coming from Donald Trump, we're probably going to end the year with a core PCE inflation rate of something like 2.8%. That's usually your best bet for what inflation is going to be going forward. Then you add to that some fiscal expansion, some tariffs. We don't know the magnitudes of those, but they both push in the same direction. You're adding even more to inflationary pressures. I think that's going to make it hard for the Fed to continue its process of rate cuts at anything like an every meeting pace next year, maybe every other meeting at best, with an exception. If the economy starts to weaken, they'll be there. But absent that, we have strong growth, we have high inflation, hard to keep cutting.
Hang on, Jason. So save for their cutting bias, should they even be cutting in December? Does that even make sense with the environment that you just laid out?
Yeah, interest rates will still be contractionary after one more cut. In some sense, the way the Fed operates is they always wait longer until they're really sure, and then they start a continuous process of change. And that's where they are now. I think it would be sort of too shocking to the system to pull that one back. It would almost also look a little bit political. But yeah, after December, they need to take a hard look at the data. And I don't think it's going to say, keep cutting.
If we can go to that environment where you have higher yields and a stronger dollar because of whatever the Trump policies are, but because they're not cutting every single meeting, that means you globally have tighter financial conditions and maybe force rate cuts elsewhere, which again feeds this feedback loop of stronger dollar, higher yields in the U.S. Jason, what is the likelihood of that type of global environment where you do get this sort of doom loop with rate differentials?
Look, in some ways, a weaker currency is useful to a lot of countries around the world, which are struggling with demand. The higher dollar, in a sense, is shifting demand, from the United States to those countries. So in some ways, that's going to help with the global equalization. But Europe is in just a very different place than us right now. They have really weak growth. We have really strong growth. That means monetary policy should be different in those two economies.
Jason, good morning. You wrote in the Journal in September time that Trump often listened to sensible advisors and walked away from some terrible economic policies as a president. What do you think he will walk away from? Anne-Marie's been making this point that he's watching the betting markets, he's on Twitter, he's on Truth Social, he's watching everything. What's the worst policy that he will walk away from the campaign trail?
My guess is that, well, first of all, interfering heavily with the Federal Reserve, I think he'll walk away from that. The market would punish that very severely. Second, I hope he walks away from across-the-board tariffs on every country in the world. On the one hand, he does have a deep-seated belief in that. On the other, that would just be really destructive to the U.S. economy. Where I don't think the market will put much pressure, though, is on fiscal expansion. Do I think he could do, the $8 trillion he proposed on the campaign? Probably not. Do I think he could add $5 trillion to the deficit without tanking the market? Absolutely, yes. And so it's that fiscal expansion that I think is the most likely to make it through the screen.
I'm curious what you define as tanking the market. My inbox is littered with 5%. It's like a number that keeps ringing up on a cash register at the moment on the bond yields. So just talk me through that.
Yeah, look, we get to 5% on the 10-year. I think that will get attention, probably from the president, and if not from, four Republicans at least four Republicans in the Senate. That's what our fiscal conversation to date. We had too much deficit increase over the last 4 years. Harris was proposing too little deficit increase. Both parties are a part of this, but part of why they have is that interest rates have allowed it and the bond markets have allowed it. Let's see if the bond market vigilantes come back when they start hearing about these multi-trillion-dollar deficit increases.
Well, Larry Summers was saying that maybe it's going to be up to the bond market to educate lawmakers in Washington, D.C. Do you think that's what forces Washington to coalesce around actually being a little bit more disciplined when it comes to the U.S. trajectory, the fiscal health?
Yeah, I think that's pretty much the main thing that could get people's attention. I would have thought that the Social Security and Medicare trust funds being exhausted within a decade would get people's attention. I would have thought, nearly $2 trillion deficit at a time when the economy is really quite good would get people's attention, but those haven't. So, yeah, I think we need the market at this point.
So that's basically a Liz Truss moment. Is there a timeline, Jason, that you think this could happen? I mean, with a Republican trifecta, nearly, once we get the results of the House, do you think it can happen in 2025?
It can always happen, but it could always not happen. And I realize that's super unhelpful, but it's not like there's some mathematical link between here's the quantity of deficit and debt and here's some discontinuous change in interest rates. Markets are trying to assess not just where the deficit and debt are, but where they feel policymakers could go or would go with it with future actions. I think with Liz Truss, it was the sense that she was just completely recklessly ignoring any sense of discipline around this. That then interacted with a set of quirks around insurance companies, regulation, and the like. Things like that are hard to spot in advance. But yeah, that's what I would be worried about if someone picked, in the unlikely event that someone picked me to be Donald Trump's Treasury Secretary.
I hate to say that to you, but it's a very unlikely event. But former Obama economic advisor, Jason Furman, thank you so much for joining us in your time this Monday morning. Let's give you an update on stories elsewhere. Here's your Bloomberg Brief with Yahira Hackis. Hey, Yahira.
Hi, Anne-Marie. Let's check in on those congressional races still underway. Republicans have secured the majority in the Senate with 53 seats currently called, compared to 46 for the Democrats. But we're still waiting for results in Arizona, where Democrat Ruben Gallego is leading Republican Carrie Lake by around 2%. But that Senate race is still too close to call. In the House, the majority is still up for grabs, with 18 races still being counted. The latest tallies show Republicans ahead with 213 seats compared to 203 for the Democrats. Meanwhile, hedge funds betting against Tesla are feeling the brunt of a Trump win. Firms that were short Tesla between Election Day and Friday's close took an on-paper hit of over $5 billion, according to our calculations here at Bloomberg. Those hedge funds were among the few holdouts that were affected, since many of their peers unwound bets against Tesla over the past 4 months as markets started to price in that Trump would win the White House. Since Election Day, Tesla shares have gained close to 30%, totaling well over $200 billion in added market value. And China is on track to become Lululemon's second biggest market after the U.S. The brand has hit $1 billion in China sales for the first time this year, and it's selling more expensive items than in the U.S. The growth comes at a good time for Lululemon, which has seen a marked slowdown in North America. Its success in China also comes as other Western brands are struggling in the country amid rising nationalism and a strained consumer. That's your Bloomberg Brief. Anne-Marie.
Thanks, Yahira. What I don't understand is LVMH, Kering, L'Oreal can't get it done in China, but Lululemon.
So I was reading into this, and Reuters has this story where they talked that Lululemon has positioned themselves as the Hermes of yoga in China. I don't know what that means. I feel like you should be charging more than $150 per pair of pants if you're the Hermes of yoga.
I wonder if you actually charge more if they've got the rips in them. You know, sometimes you see people go.
Maybe it's because they're Canadian.
Maybe it's because they can. Look, I mean, there is a bit of a difference between $150 yoga pants and a Louis Vuitton handbag, to be fair. You know, in terms of the price range, and you're right, they're not getting it done. It could be nearly $13 billion of their sales, making Lululemon more reliant than Apple, Nike, or Starbucks. It's in the story.
Maybe for Chinese consumers, this is affordable luxury. I never knew. Lululemon, affordable luxury. All right, up next, bracing for the next administration.
The direction of travel is clear. U.S. dominance of the global system is going to increase, both for positive reasons and for negative reasons.
That conversation coming up next. You're watching Bloomberg Surveillance. Good morning. Under surveillance, bracing for the next administration.
The direction of travel is clear. More growth, slightly higher inflation, a higher public sector borrowing requirement, and a huge sucking sound where a lot of foreign capital will end up in the US. This is a period in which US dominance of the global system is going to increase, both for positive reasons and for negative reasons.
Here's the latest. Traders are split on what Donald Trump's economic agenda will mean for the U.S. economy and the Federal Reserve. Former Chicago Fed President Charles Evans writing there is substantial optimistic commentary for the economy owing to lower taxes and more business-friendly deregulation, but higher tariffs could affect the inflation outlook for 2025. Charles joins us now. Thank you so much for your time this morning. Let's get into that when it comes to the inflation target and tariffs and how to balance the two. Is a 2% inflation target doable with the higher tariffs that President-elect Donald Trump was promising on the campaign trail?
Well, good morning. Well, 2% is the Fed's inflation objective. And ever since they were, raising rates and when they, put the funds rate at 5.3%, they said they needed confidence to get inflation back down to 2%. We've seen improvements in inflation and there's been a lot of optimism. But most recently, the CPI PCE data has been a little bit bumpy. And I think since Jackson Hole, when Powell said that it was time to cut rates and the Fed has cut rates 75 basis points, things have probably been bumpier on inflation than they were expecting. So I think they're going to be cautious. And then in this new environment with the prospect of tariffs, that's like, that would increase prices one-off, not necessarily inflationary over the longer period of time, but a rise in the prices around, where, imported goods and things like that. And that would create a problem for the Fed, I think. A challenge in terms of interpreting the inflation data. That's what I mean.
It's a conversation, though, that at least publicly, Charles, that the Fed is not having. Kashkari yesterday saying it depends what things actually look like. Powell during the presser saying we don't guess, we don't speculate, and we don't assume. You've been in the room where conversations have happened. What do you think is likely the conversation around politics and the type of environment that they will be facing?
I think Powell described it really well during the press conference. He said, when you've got new fiscal policies that have been floated, the Fed is going to be paying attention to what's put into the law, what's actually enacted before that. They're paying attention to what possibilities are. They're, gaming out what some alternative simulations are and what policy responses likely need to be. But you really need those details. I actually thought back in early 2021 that the Biden policies weren't quite as inflationary based upon early things that we'd seen. And then as you actually got them into play, they were more stimulative than I thought, and others too. So you really need to see the details in the implementation. And so that's what they're waiting for. And that's what, you'll hear a lot of talk about that until you actually see proposals put on the table and moving forward.
Charles, good morning. You were there for the first Trump administration. You lived through those tariffs and the conversations that you had around the table. Here is a Fed that's dealing with unemployment of 4.1%, inflation theoretically coming back towards target. Should there be a case to build pause into the narrative, or does the Fed continue on its trajectory until we see the detail on these tariffs?
Well, I mean, they are going to need to see details on the tariffs. It is the case that the economy is really quite strong. I mean, as you mentioned, unemployment's 4.1%. Employment growth on average has been pretty good. The last month it was a little bit weaker, but NIPA revisions to GDP, that looks good. So you put that in this environment, and I think the Fed is already. They're recalibrating, but they're not quite sure, how much restrictiveness they need. Maybe they need a little more than they thought back in the Jackson Hole days. Now you bring tariffs into play, and you begin to wonder, in that environment, businesses were able to raise prices, back into, it's just been hard for businesses over a long period of time to raise prices unless there was identifiable reason. And so tariffs give them an identifiable reason. That could be something that sort of changes price setting behavior in a way that makes it more complicated in terms of assessing what inflationary pressures are going to be. So they're going to need to see some things.
So, Charles, 60 seconds left. Does that mean potentially no cuts in 2025?
No, I think that they're really still quite restrictive. I think that they don't want to get ahead of themselves. Probably they're going to be cautious. And so, Powell said at the press conference, they're going to go into December and they're going to be asking themselves, we've done 75. Is that where we need to be? I think, December, I think they'll follow through on this, but I think that they'll adjust the pace in 2025 and be ready to, move it in either direction, depending on if the economy is weakening. They could ease more, but if inflation is holding up and it's really more of a concern, they'll probably be even more cautious in reducing rates, but they'll reduce rates in 2025. How much? That's a good question.
Charles, thanks so much for your time. This is former Chicago Fed President Charles Evans. Coming up in the program, Michael O'Rourke of JonesTrading, Bloomberg's Craig Trudell, Kathy Bostjancic of Nationwide, and Oksana Aronov of JPMorgan. You're watching Bloomberg Surveillance on Bloomberg TV. Good morning.
The U.S. economy is just doing so much better than the rest of the world.
This is a period in which U.S. dominance of the global system is going to increase, both for positive reasons and for negative reasons.
You're really going to start seeing the market focus on the impact of tariffs.
There seems to be something about political leadership transitions that help usher in some leadership style transitions within the U.S. equity market.
Markets have trouble pricing election risks, period.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning from New York City to our audience worldwide. This is Bloomberg Surveillance. This morning, alongside Danny Berger and Manus Cranny, I'm Anne-Marie Hordern. John and Lisa are off today. Lisa will be bringing us some interviews. She's on assignment. And John is getting a much-needed rest after, I think, doing 30 hours last week on television. So he deserves a little bit of a break. The story, though, hasn't changed since the presidential election, and that's the Trump train on the Trump trade continues. S&P 500 securing another record on Friday, 50th all-time high. The market thinks this rally has more room to run, pricing in deregulation, pricing in tax cuts, even though we do not have the makeup of the House of Representatives yet. But also, my question is, when will the market start pricing in the tariffs? And at some point, when that bleeds through, is that going to be an issue for the Fed to potentially say, we might have to pause these cuts?
You said it really well earlier, Anne-Marie. This market is pricing in all the good stuff and none of the bad stuff. At what point does this start to look like 2016? If you'll recall, in 2016, we had this big rally post-Trump. Everybody's really excited. Animal spirits come up. And then we kind of pause and we move sideways as we try to figure out what policy actually looks like. That could be when you start to get tariffs priced in, especially as you start to learn who's going to be appointed, what the cabinet will look like, and what the priorities are.
And depending on who's appointed, then that could restrain, not stop, but maybe just temporarily restrain some of the extreme policies that have been floated on the campaign trail. And that has got repercussions, Danny, for both the yield spike, which we saw just abating a little bit last week, but nothing can stop the dollar at the moment. The euro dollar is the lowest since June. The euro has a problem. It's called Germany. Germany and France. That is the narrative from Kit Dukes. We've got an election coming up in Germany. You've got a trade surplus in Europe of $158 billion. So if you're going to do 60% tariffs on, let's say, your enemies or your angst, which is China, what would you do to your pals? What would you do to your BMW pals in Germany? Is it 20%? Is it 30%? Is it something a little bit lighter? Either way, you look at it, there's no growth in Europe, and we are careering, according to Mark McCormick this morning on TD, who was with me on Bloomberg Brief, towards parity.
And Mark McCormick brought up a great point to me last week. Political economy almost means so much more now to these markets than central bank policy. And we really see that bleed out when it comes to the Trump trade. We should also note today is Veterans Day, so the bond market is closed. The rest of the week, we are looking forward to CPI, PPI, jobless claims, and retail sales, potentially the next catalyst for this market. Coming up in the program, Michael O'Rourke of JonesTrading as the Trump trade continues to gain steam. Kathy Bostjancic of Nationwide looking ahead to CPI. And Oksana Aronov of JPMorgan as bond traders speculate whether the 10-year could reach 5% yet again. That's an interesting conversation. You want to make sure you're here for that. But we begin this hour with stocks. Once again, they're higher as investors remain bullish on the back of Donald Trump's election win. Michael O'Rourke of JonesTrading saying optimistic but selective. The post-election market is euphoric. Banks and energy have been beneficiaries of the Trump trade, but still have room to rally and are relatively attractive versus the S&P 500. Investors should be cautious and single stock selective going into year end. Michael joins us now. So, Michael, tell us what you like and what potentially you want to be a little bit more cautious on, because the market right now is still euphoric and they're still pricing in more of this Trump trade as we begin to see the personnel taking shape for Trump 2.0.
Yeah, I think Danny made a great point that everyone's seeing the bright side of every one of these trades. It's as if every Trump trade's in a vacuum to itself, and they're all going to be winners. And I think that's a big mistake. And if we all think back to 2016, I remember after the euphoria died down, there was a lot of volatility because you get headlines about one policy is going to pass and another one's not. So you have to view the market a little more selectively. Right now, the Magnificent Seven still are driving everything from an index perspective. I would guess with Tesla up another 6-7% today, that group is trading about 50 times earnings. And the rest of the S&P 500 is about 17.2 times trailing earnings. So there's a lot, the index is expensive. There's a lot of stocks out there that aren't as expensive. And I think that's why you really have to be selective and not get wrapped up chasing this euphoria that we've seen in the past week.
Michael, you remind us of an era I think a lot of us forgot about in 2016 and onwards, when markets moved based on different tweets, on different policy pronouncements, and then they moved a little bit more as the administration tried to figure out exactly how to implement what Trump want. Mike, does that mean it turns us all into short-term traders? Do we need to have more agility and flexibility over the next 4 years?
Well, I think people are acting like short-term traders right now. I think that's why you want to be a little more thoughtful. I describe it to my clients and my coworkers as expect a roller coaster ride, because even though we know what the trend of what the policies are going to be and what the intentions of the policies are going to be, they're not, they don't work out that way exactly. For example, in the first Trump administration, the president really wanted to put the tariffs on Chinese imports. The biggest importer from China was Apple. And he, of course, gave Apple a waiver for iPhones because he wanted to be able to compete with Samsung. So to make a broad-based judgment, week one after the election, it's a very dangerous game to play. And I think that's why people need to be a little more thoughtful.
Fair enough. So in that thoughtfulness, I want to ask about energy, because energy was one of those sectors that ripped higher into this election, the assumption that Trump wants drill, baby, drill. But with domestic oil production already at a record, how much room does the energy trade have to run at this point?
I think it has room in the sense that valuations, it is the cheapest sector in the S&P 500, and you have some very, very expensive sectors. So I think there's potential there, but also we are all hoping for a good growth situation here in the United States. We're hoping that obviously if we shift investment domestically or inwardly, that should also help grow. So I think there's potential. There's been a lot of headwinds in the space. Of course, the current administration hasn't supported the space. We've had the China slowdown. So there's been a lot of negatives out there. So there's room for upside surprises.
Well, tell me this then. In the KBW index, it's up $237 billion since Trump's win on Wednesday. So the next leg of that trade is a lighter capital touch. How do you see banks? What are the repercussions for that in buybacks, dividends, never mind the bonuses?
Yeah, I think the Silicon Valley Bank story just highlights how wrong regulation has been. We have three major regulators: the Fed, the OCC, and the FDIC. They all knew the problems were there. The Fed told the bank to correct the problems. The bank never corrected the problems. And then the Fed's policy response to that was to increase bank capital requirements on everybody else. And that's exactly what's wrong. And that's why it should be viewed as a major positive to see that, a new administration come in and hopefully changes from the regulatory structure. From that perspective, the financials, the banks specifically, are another extremely inexpensive group relative to the market, with the S&P trading 25 times earnings. The banks as a group are probably 12, 13 times earnings. So there's, again, tremendous potential for upside here.
Can we just circle back to Danny's point? Danny was talking about energy, oil production. Is there room? Is there capacity? From an equity investment perspective, if I don't look at the oil majors, do I look at the supply chain into that? Do I look at the narrative of who builds U.S. Energy Inc.?
Yes, I absolutely believe that. I think you want to see an environment that's more friendly to, obviously, exploration and production. And I think that as long as there's demand there, we'll see more infrastructure build out in the U.S. Obviously, with China slow right now, there's still questions out there. But hopefully, when you look over the next several years, you see more strength in that group and you see more of that build out.
Michael, we started this conversation with the post-election winners being the winners that have been much of this year. You mentioned Tesla flying higher in the pre-market, big tech doing well. You write that we are in bubble territory. What pops the bubble? Is there anything realistically at this point when, if you'd cared about valuations for much of the past half decade, you probably would have been wrong? Is there anything that can really reverse some of the enthusiasm that we're seeing in tech and Tesla specifically?
Well, okay, so it's interesting because Tesla, I believe, was flat year to date 10 days ago, So that's a specific scenario. As far as the other big tech and their rally in the past week, I think that's just an exposure grab. We know the likes of Meta and Google are not, President Trump's favorite companies. So I think that's just their large weighting in the index. We know, Warren Buffett's been selling Apple. And for all these headwinds out there, the group hangs in there. But as we see a shift to other groups, as we see a shift to small caps and mid caps, and that trend started over the summer back in July when we got the June CPI. I believe up until Tesla rallied the last week, the only Mag 7 names outperforming the S&P 500 since then were NVIDIA and Meta. So we're seeing that shift occur already. And like I said, it's these mega cap names that are in bubble territory. For the most part, the standard stock in the market's not extremely expensive. Small caps are, the S&P 600 is still relatively attractive. So there are, places to be in this market. But to your point, that rising 10-year yield's an interesting story. I personally don't see it in the sense of you're worried about deficits and Trump, whether it's tax cuts, et cetera, driving yields higher. We have Japan with a 1% 10-year, and I believe their government debt's about 260% of GDP. So I think, again, some of these Trump trades get ahead of themselves, but where we're at right now, the 10-year yield is about 40 to 50 basis points above the S&P 500 earning yield. And that's what shows stocks are expensive. But again, it's driven by those mega caps.
Is there a point where yields get high enough that it upsets the risk trade? Is there a level where you'd start to get worried, and what is it?
Oh, no, absolutely. I mean, I know everyone's talking about 5%. I do think if we approach 5%, I think equities really start correcting. And don't forget, for all this investment and this growth that we want, you do have to borrow money. There is a cost of capital. When we talk about the mega caps who are self-funding for the most part, they're already expensive. So if you really want to have growth in this economy, we can't talk about, interest rates shooting higher and then still having, a strong economy. It's just unlikely, and it's probably not going to happen. So I think I think the 10-year is very attractive at the 4.35% yield. But again, if you see that move towards 5%, expect equities to get unsettled.
How much consumer do you want to take on board now? Because we're in this rate cutting cycle. We've run out of COVID money, but we have got the capacity to leverage at a cheaper rate.
Yeah, the consumer is interesting because the consumer does seem a little stretched here. Obviously, we've had a great expansion. We've had a phenomenal bull market, so we have somewhat of a wealth effect. I do think the tariff situation, again, makes that all tricky because obviously imported consumer goods are going to be one of the places that get targeted. So, without seeing things necessarily, put it this way, even if the consumer's strong, a retailer might be under margin pressure. So I think it's one of those places I think you have to watch and wait.
Do you think the market is taking Trump at his word when it comes to tariffs? It doesn't seem like it.
I think the market's taking Trump at his word that he's going to try to do something. Again, if we have a massive tariff structure, it's going to hurt parts of the economy. I talk about it all the time. The pre-globalization era from 1960 to 2000, GDP grew 3.5% here. China entered the WTO in 2001. GDP was cut in half, essentially. And what we wound up doing is trading GDP and jobs for lower consumer prices or lower inflation and higher corporate profits. If we start flipping things the other way, it becomes a little more of a challenge for stocks. I don't see that totally reversing. But again, it's something Trump started on in 2016, and now he's back in office, and he gets to build on that. So I think you just have to be, again, it comes back to selectivity. You have to be very selective in what you want to be invested in.
But you're right. He's promising a back to the future. Michael O'Rourke of JonesTrading, thank you so much for joining us this morning. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hackis. Hey, Yahira.
Hi, Anne-Marie. The Kremlin is denying a report that President Vladimir Putin held a phone call with U.S. President-elect Donald Trump. Putin's spokesman said reports of the call were, quote, pure fiction. This coming after the Washington Post reported that Putin and Trump spoke on Thursday and discussed the goal of peace in Europe. As for any future calls, the spokesman said there are no specific plans yet for any contact between Putin and Trump. Meanwhile, Cigna shares are up 8.5%, while Humana shares are falling more than 6% in the pre-market after Cigna announced it will not pursue a combination with the insurer. Cigna said it's focused on affirming its capital priorities and would only consider acquisitions that are, quote, strategically aligned and financially attractive. The company will continue repurchasing shares through year-end and into 2025, with Cigna saying that it intends to use proceeds from its Medicare business for the buybacks. And it was a busy week 10 of the NFL season. The Carolina Panthers kicked a game-winning field goal in overtime to beat the New York Giants in Munich, Germany. Meanwhile, the Steelers hold on to their division lead after a dramatic fourth quarter finish against Washington. As for the Chiefs, their undefeated season marches on after they blocked what would have been a game-winning field goal in Denver in the game's final seconds. And the Lions improved to 8-1. Their win came despite a 5-interception night from Jared Goff, thanks to a game-winning field goal as time expired. What a comeback. That's your Bloomberg Brief. Anne-Marie?
Yahira, thanks so much. Look forward to your update in 30 minutes' time. Up next, the morning calls, plus Bloomberg's Craig Trudell on the outlook for EVs in a second Trump administration, particularly Tesla. Elon Musk hanging around Mar-a-Lago all this weekend. That's coming up next. You're watching Bloomberg Surveillance. Good morning. After the S&P 500 hit another record high, 50th record high. Torsten Slok, I love this morning, writing in, Danny brought this to my attention. On average, just for some reality check, on average, the stock market closed an all-time high 18 times this each year. 2024, unmatched when it comes to any other year. We're already at an all-time high 50 times this year. And you can see that bleeding through the markets this morning. S&P 500 futures up nearly 0.4%. We should note the bond market is closed today for Veterans Day. Crude, though, this morning, WTI down more than 2%. Has to do a lot of what is going on in the lack of demand that we are seeing coming out of China. New York crude, $68.83. Time now for the morning calls. First up, JPMorgan upgrading Valley National to overweight, citing its reduction in commercial real estate concentration. That stock is up more than 3%. Next up, we have Morgan Stanley raising its price target on Dell to $154, noting its strong AI server momentum. That's giving some weight to the stock this morning, up more than 2%. And finally, no surprise here, Wedbush raising Tesla's price target to $400. Dan Ives has been on this train for a while, expecting a Trump White House to be a game changer for its autonomous and AI ambitions. Let's stick with Tesla. The automaker continuing its post-election surge. Tesla's market cap now back above $1 trillion. Bloomberg's Craig Trudell joins us now. You know, Craig, over the weekend, a source close to me that's been hanging around Mar-a-Lago said to me, well, Elon Musk is secretary of everything. That's what's behind this move?
Yeah, I mean, I think if the sort of simple thing to do is, buy the shares of the companies whose CEOs are hanging around Donald Trump, it stands to reason that you would buy Tesla, of course. But I do think it's kind of remarkable just in the sense that, everything that we heard out of Donald Trump on the campaign trail, would sort of lead us to believe that he's going to be anything but, a proponent of electric vehicles. And so how exactly the market eventually squares that after this, post-election enthusiasm is going to be, really interesting to watch, because there's a lot of ways that he could hurt the EV market going forward.
Well, so that's what I'm struggling with. This would mean more tariffs, potentially clawing back the Inflation Reduction Act, which had subsidies to American consumers for buying electric vehicles. At the same time, maybe his proximity to power means more autonomous driving and deregulation. Is that what the market's looking at? All the good things, none of the bad things?
Yeah, I mean, I think with tariffs, I think Musk is kind of sitting pretty there in the sense that, he makes all of his vehicles that he sells in the U.S. For the most part, in California, in Texas. There are plans to make semi-trucks in Nevada. You've seen some limited imports from Tesla, but quite limited in the U.S. And so, maybe there is a case to be made that, you stand less of a challenge to, say, the Germans in particular, if Trump follows through on his threats against imported cars from Mercedes and BMW. But then again, those companies make an awful lot of their vehicles now in the U.S. And so I think trade-wise, maybe it's a plus. But in terms of EV policy, you mentioned IRA. There's a lot of attention on tax credits for purchases. But I think what often gets overlooked is manufacturing tax credits as well. Tesla's a huge beneficiary, along with Panasonic, because of all of the batteries that they make domestically. So it's not just a matter of consumers potentially losing out. It's also Tesla directly.
Craig, how does the timeline change, if at all, for autonomous vehicles and FSD for Tesla in the United States with the result of this election?
I think it's really difficult to answer that at this point, because we have heard Musk himself talk about the idea of he would want to try and sort of put his thumb on the scale toward a federal protocol or procedure for approving autonomous vehicles, getting them on the road. There are challenges that companies have run into, and when they've wanted to, say, take a steering wheel out or pedals out, because if you make a car in the U.S., it needs to meet federal motor vehicle safety standards, and those standards include those sorts of controls. And so, there have been efforts going back years for companies to try and change those standards that have gone next to nowhere. Perhaps Musk would be able to kind of throw his weight around there, but it's very unclear at this point. just how much that is actually holding Tesla back as opposed to whether its technology is actually, to where it needs to be in order to safely take out those controls from its vehicles.
Craig, good morning. As Anne-Marie said, Elon Musk is pervasive. He's everywhere politically and socially. So we spent a lot of time talking about the tariffs. We've spent a lot of time talking about the bid for Tesla this morning. 22.5% of the revenue is in China. So we're talking about all the upside and none of the potential headwinds that could come politically in China with his relationship with Trump.
Yeah, I think that's right. And I do think, the potential for Trump to necessarily put a huge dent in that seems limited in the sense that a lot of the vehicles that they are making in China are for China. To the extent they are exporting, they're not exporting to the U.S. It seems quite unlikely, of course, that would change given Trump's China rhetoric. But I do think it will be also very interesting to watch just how much Musk tries to kind of assert himself as someone who speaks for China, because we've not seen him as a hawk on China at all. In fact, he's been quite an ally and, been quite distinctive from the Trump camp in terms of, China's strengths and kind of speaking up for the CCP. So, whether or not he sort of continues down that path, I think will be something that, I'm watching very closely because he is so far apart from Trump in this respect.
Craig, thank you so much for your time this morning. Bloomberg's Craig Trudell. Of course, Dan Ives this morning basically maintaining that overperform, but saying FSD autonomous, they clear significantly under a new Trump era because proximity to power for Elon Musk is there, present for us all to see across Twitter, especially over the weekend. All right, coming up on the program next, Kathy Bostjancic of Nationwide and Oksana Aronov of JPMorgan. You're watching Bloomberg Surveillance. Good morning, 8:30 a.m. here in New York. I'm Anna-Marie Hordern alongside Danny Berger, Manus Cranny. John and Lisa are off today. Equity futures up nearly 0.4% in the S&P 500 futures. So-called Trump trades in full swings. Maybe we are going to test a fresh record on Friday. The index posted its 50th record high. And Manus, so much of this has to do with the Trump trade darling, and that's Elon Musk and Tesla.
Yeah, and as you said, how much of this is Elon Musk, secretary of everything, and how much of it is to do with a real reevaluation and reappraisal of Tesla's trajectory. There you go, up 6.73%. You've got Dan Ives raising the price target there, as we said earlier, to $400 from $300. I mean, this is a Trump White House win. Will be the game changer for autonomous and AI and for Tesla and Elon Musk over the coming years. And AI and autonomous is going to be worth $1 trillion for Tesla alone. That's what Dan Ives writes. Let's move it along. There are some other powerful moves around this morning. We've got Coinbase. I mean, this is a reflection. If you ever wanted to understand the concept of deregulation and what the industry is spending $200 million trying to get Donald Trump elected, this is the manifestation of that. Up on just under 14%. Again, You've got the digital currency flying through $82,000 this morning, up 94% this year. And the daily flows are at a record into BlackRock at the end of last week. So the exchanges and the ETFs are really trading higher. And then a little bit of a confirmation at the moment. This is Cigna confirms it is not pursuing a combination with Humana. And you have that small relief trade for Cigna and obviously Humana on the other side of that. In terms of what they're actually saying, they remain committed to established M&A criteria and will consider acquisitions that are strategically aligned. What a wonderful line. Strategically aligned and financially attractive and have a high probability to close, the company says. Whoever wrote that, they deserve a star.
Yeah, let's see how they open up at 9:30. Coming up in an hour when we have equity markets opening, we should note to our audience, it is Veterans Day, so bond market is closed today. Investors awaiting plenty of data, though, this week and Fed speak, including CPI, PPI, and Thursday remarks from Fed Chair Jay Powell. Joining us now is Kathy Bostjancic of Nationwide. Kathy, what are you most excited for this week? The Fed speak or the data?
Good morning, Anne-Marie. Well, I'd say all of the above, but I think the data matter most. And particularly, you mentioned the consumer price report due out on Wednesday. And, to us, that's really the critical key data to watch going forward. The Fed Reserve, they have an easing bias. We found that out last week. They still retain that. The recent stickiness of inflation reports hasn't, dissuaded them from thinking they can continue to, gradually lower rates. But I think the pace and the timing is really going to be dictated by these incoming inflation reports. Comes in a little bit higher, dampens the odds that they will, go in December perhaps, or even, follow up in January.
Kathy, what is that level that we could get for the CPI this week that would mean we don't see a cut in December?
So it's a close call, like in general. So we are right in line with consensus. We're looking for 0.2 headline increase and then 0.3 core. And we the headline is going to be a bit softer because gasoline prices have come down, over the last few months. The core, that's a kind of like right on the borderline. I think anything higher than that, if you get a 0.4 or higher reading, that's going to knock down the chances of the Fed, cutting in December. They could easily, pause and say, we need to see more data. I think on 0.3 they could go, but it's always the composition, right? What's happening in certain categories, and are they likely to persist? And really, are they affected by interest rates? That's a key determinant as well.
Well, Kathy, to that point and the impact of this market, because Powell was at pains to avoid talking about the politics. Kashkari basically saying in so many words that it depends on what policy actually gets passed. But it's a market that's run away with it. It is stocks, it is equities going out, having a good old blast, moving higher, their 50th record so far this year. Is there a point where the Fed needs to start talking about financial conditions moving away from them? They're okay with that easing bias, but is there a point where they bring this up again, the market getting out of their control and something they want to wrestle back?
Well, great questions. I mean, certainly we know they take into consideration financial conditions and the broad financial conditions. What's kind of interesting going on, the dynamics right now, as you said, the riskier assets, equity market, and even small caps, rallying quite strongly as part of the Trump trade. But we're also seeing long-term yields, they've moved higher. Now, they've been volatile. Some days they're up 10, 50 basis points, it seems, and then they fall similarly the next day. So there's a lot of volatility. But bond yields have, moved up a bit. And one, that's a reflection of stronger economic growth than expected, right? So we're moving the downside risk. Also, maybe a little bit of inflation premium coming in, and also concerns about the deficit, which, by the way, that was rising even before the election outcome became true. So I think we have to keep in consideration that as long-term yields go up, so do mortgage rates. And housing is still a powerful profile, part of the economy and a multiplier effect. And that's where we have to have a holistic view of what's happening really with financial conditions and how it's impacting the economy.
Kathy, good morning. We caught up with Charlie Evans, who was at the Chicago Fed during Trump 1, during a whole host of events, the global financial crisis, to name but a few. He suggested near the end of that conversation that the Fed were in a recalibration mode. They may well go in December. What does recalibration 2025 look like? Could you see an extreme scenario where there are no rate cuts at all in 2025? What would it take to do that kind of pause?
So, we also have the view, they're recalibrating back down to what they think eventually will be a neutral Fed funds rate. And they currently believe that they're still in a restrictive stance, and they want to get, that to a healthier balance, right, for the economy, because as they see inflation trending lower, they also see some softening in the labor market, not to the point where, it's alarming, but certainly they want to support that and continue to keep that type of strength going forward. For 2025, there's so much uncertainty right now. We don't know what's going to happen on the trade front, immigration, and we don't know how the arguments and the fight over taxes will play out. Now, they don't expire really till 2025, the bulk of them, but still 2025 is going to be all about deciding these policies. And that will have some impact. But my sense will be that notwithstanding all of these changes, that we're likely to see the Fed continue to cut rates. It just be maybe more gradual than previously thought. And I think the bond market is kind of priced that in. We're looking probably for the Fed funds rate to end 3.5, 3.75, somewhere in that category, which I think is still very supportive of the economy overall.
I mean, it's dealing with the known knowns and the unknown knowns. To that point, it looks and sounds like there's going to be a bit of a hard rubbing up against politics and the Fed when you listen to Powell's answer succinctly, no. Were you happy with that answer?
I was, actually. It was quite firm. It was to the point and kind of no nonsense. I think that, I think ultimately, I would hope that the financial markets really be the final arbiter here, right? And that let's preserve Fed independence, and let's not rock the boat, because, as you said, markets seem to be very joyful right now. One would think the Trump administration would want to continue that type of environment.
Are they too joyful, Kathy? I think about the fact that we still don't know the makeup of the House. Whether or not the Republicans actually have this trifecta could mean whether or not we're going to get those tax cuts that President-elect Donald Trump has promised.
Yeah, absolutely. I think it's premature right now to bank on really any, decisions on any of those key, policy fronts. And we do need, more information, some more clarity on the House. And now, of course, the fact that the Republicans have control of the Senate, they can push to things on omnibus, resolution bill. But it makes it a lot easier, right, if for the Republicans, if they also have control of the House. So we'll just have to wait and see and see how that plays out. I think at this point, it's not surprising the markets are going ahead and running with the Trump trade, but I think there's a lot of information we have to dissect going forward to really see ultimately what does this mean.
Kathy, thank you so much for your time this morning. Kathy Bostjancic of Nationwide. Joining us now around the table, Oksana Aronov of JPMorgan Asset Management. Oksana, thank you so much for joining us. You just heard from Kathy there, talking about the markets pricing in this Trump trade. When you look at the rise in yields, is that economics or do you think it's politics?
So I want to start answering that question actually by zooming out a little bit, because we spend a lot of time in markets trying to predict rates. Obviously, that's the backbone of the market, whether you're talking about bonds or stocks. But the reality is that when we look at the history of how good is the market consensus provided by Bloomberg at predicting where the 10-year will be, it's actually pretty terrible. How good is the Fed at predicting where the Fed funds will be? It's actually pretty terrible. Because if you look at their dot plot, in an extreme example, in 2020, they expected the Fed funds to stay at zero all through most of 2023. So with these things in mind, and by the way, even when you know what the Fed is going to do, and they do it, like cut 50 basis points earlier this year, which seemed kind of unnecessary given the strength of the economy, but they did it. What has happened to the long end of the curve against the calls of extending duration? The longer end of the curve moved up with 70 basis points. So all of this to say that I think everyone needs to have a little bit of humility and really focus on the economy and the data. And Powell himself said last week that, look, we're not going to prejudge anything. We're going to be really looking at the data. And I think that a lot of what's in the mix right now with the new administration coming in is potentially short-term, at least, looks quite inflationary. And that means, possibly higher longer-term rates, which of course are also looking at the state of our balance sheet. And that process started way before the election. We've been saying that, look, regardless of who occupies the White House in January, there is really no focus on fiscal spending. I mean, everyone wants the accountability in theory, but everyone wants to spend on the things they want to spend.
So is that a 5% on the 10-year?
So if you look at what the market is currently pricing in for the Fed funds rate, we have about a 3% rate by the end of next year. Historically, the spread between Fed funds and the 10-year Treasury is around 175 basis points. So you do the math. So even if markets' expectations come true and we have a 2.93% Fed funds this time next year, is a 5% 10-year more likely or a 4% 10-year more likely or a 3% 10-year, right? So if you believe in a positively sloping curve, that 10-year is going to be likely higher as opposed to lower, not to mention all of the longer term issues that are inflationary that we can talk about. But that's just the math. Now, what will actually happen? Your guess is as good as mine. Again, and that's why we do not pin the fortune of our process on the directionality of rates, and maybe that's why we've actually outperformed strategies that track indices in fixed income by 14 to 16% over these last very volatile 3 years in fixed income, which is a lifetime of return in fixed income, frankly.
Well, to that point, before we'd gotten the 50 basis points of cuts and yields move higher, so many people had talked about the reinvestment risk in this market, that you need to be going into bonds because yields will come lower. What psychological impact has it had for investors for that not to play out? And how real, still at that moment, is this reinvestment risk if there is some potential for yields to go higher from here?
So right now, as we look out, and it seems that a higher for longer environment is more likely, and the Fed is going to be looking at the data, and to the extent that that data continues to be strong and we possibly see even an uptick in inflation, they may stop cutting or even take some of those cuts back. So we definitely believe there's nothing wrong with cutting clipping that coupon at the front end of the curve, and that's been the right trade. And so we like things like high quality corporate floaters. They still give you a yield above traditional kind of front end money market type yields, and incredibly high quality. To level set kind of what's happening in the lower credit market, because that same thinking has pushed people out into lower rated, junk rated parts of the market. You have high yield spreads today sitting at 285 basis points over treasuries. It is extremely rare to see a spread inside of 270. This is incredibly tight. And the last time we saw spreads at these levels were just before the GFC and just before kind of the bubble burst in the late 90s, early 2000s. Not to say that we're headed there, but to say that, look, these valuations are definitely pushing against historic.
Yeah, IG even more so, 74-ish, I think is the spread at the moment. Tightest level since 1998. John likes to ask this question. He's not here, so I'll do it for him. Are we heading into an environment where you could see yields on credit on IG below that of treasuries?
So again, we've seen a lot of unprecedented things unfold here. I would point out that the yield on double Bs, which is the higher tier of high yield, versus the yield on 3-month treasuries right now are within hairs kind of distance of each other. So why would you buy that junk rated, right, with a 6 handle on it or a high 5 handle on it, where you can get basically that risk-free in 3-month T-bills, right? So, and if there should be a revaluation tomorrow, which we think is very likely because, to your point, IG is quite tight, and about half of it is triple B rated. So you have this enormous cloud hanging over the high yield market, and you've got names like Boeing, like Paramount, right, that don't really have an opinion on them. But you are reading headlines around their credit quality. Are they going to drop into the high yield index? That has very serious ramifications for valuations there. So at the end of the day, investors always have to ask themselves the question of what is priced in? And do I want to just let an index drag me through the experience of this repricing, whether it's caused by just higher for longer, whether it's caused by a slowing of the economy, whatever it is? Or do you want to have an active management approach that can actually take advantage of these different valuations? To your point about investment grade, one of the cheapest trades out there right now is buying protection on credit via selling it on investment grade. Cheap, 40 to 50 basis points, all-time kind of low cost. And we're taking advantage of that. But that's not the sort of thing you'll see in a market risk-driven strategy.
You say that credit is expensive and that there are a number of risks out there. I look at the Bloomberg Corporate Bond OAS. It's the lowest, 74 basis points. It is the lowest in a century. What is the biggest risk? If we're sitting around this desk every day talking about US exceptional, the fund flows that will come in here, the FDI that will come in here, the migration, not just migration to the dollar, but the sheer flow to the dollar has been immense. So what is it that challenges credit then?
So it's interesting you mentioned flow to the dollar. So if you look at assets coming into the US 10, 12, 15 years ago, were overwhelmingly going into treasuries and credit.
Yes.
Today, they're overwhelmingly going into equities. So there is incrementally less dollars going into the dollar or less money going into the dollar on the credit side. And when I talk about, and when you talk about, pricing being very tight, spreads being very tight, doesn't mean we are expecting a recession. The economy appears to be strong. But the problem is when something is priced for perfection, it takes anything other than perfection to move that price. And lower rated credit is notoriously volatile, right? So just this higher for longer environment, if it doesn't materialize that the Fed gets us to, high twos and we have to live here longer, that's a problem for cash-strapped, junk-rated companies.
Give us your opinion. Steve Rashuda was with Danny and I last week, and we were chatting about, it'll be the bond vigilantes that will restrain the fiscal largesse of Washington. They will return. It will be 1995. And Steve sort of leaned onto the desk and went, there aren't very many bond vigilantes left. So contextualize that for us. Do you believe that, he talks about a migration to other markets with Danny and myself. Do you think that bond vigilantes can be reborn? Are there so few of them?
So again, I like to stick to the facts and the data. And we know that where does the demand for treasuries come from overwhelmingly? It comes from the Fed, it comes from U.S. commercial banks, and it comes from foreign investors. The Fed is QTing. U.S. commercial banks cannot get rid of their treasury holdings fast enough. And foreign investors are dominated by China. It's China and Japan. And China, of course, we know the issues around the relationship there. There are not enough stores of value in the world, so China has continued to buy our treasuries, but at a smaller, lesser pace. So the major sources of demand for treasuries are not what they used to be, and therefore we're seeing some weaker auctions. And so I can't speak to the bond vigilantes, but we are certainly seeing some underpinnings that are in the process of change. And these things always happen slowly and then suddenly. And so that's been part of the reason why we've seen the long end of the curve migrate higher, along with better growth prospects, perhaps a return of inflation, on balance, probably not back to 9%, but somewhat of a return of inflation. All these things are not going to allow the 10-year to move significantly lower in the absence of some exogenous shock that comes out of nowhere that we cannot see, obviously, but that's why we have high quality allocations and portfolios.
Oksana, if Jonathan was here, he'd call it a clinic. I know he's disappointed he missed this. Thank you so much for your time this morning.
Thank you.
Oksana Aronov there of JPMorgan Asset Management. Let's get you an update on stories elsewhere this morning. Here's Bloomberg Brief with Yahira Hackes. Hey, Yahira.
Hi, Anne-Marie. Qatar announced it plans to step back from efforts to mediate a Gaza ceasefire between Israel and Hamas. 10 days ago, the Gulf state told the parties that it would stall mediation efforts if an agreement wasn't reached in the latest round. Now, according to a statement from its Ministry of Foreign Affairs, talks will resume when both parties, quote, show willingness and seriousness to end the war. Meanwhile, let's check in on the congressional races still underway. Republicans have secured the majority in the Senate with 53 seats currently called, compared to 46 for the Democrats. But we're still waiting for a final result in Arizona, where Democrat Ruben Gallego is currently leading Republican Kari Lake by around 2%. Yet that Senate race is still too close to call. In the House, the majority is still up for grabs, with 18 races still being counted. The latest tallies show Republicans ahead with 213 seats compared to 203 for the Democrats. And Bitcoin hit another record high earlier, topping $82,000. But as you can see, we are trading a bit below that now. The rally, of course, boosted by President-elect Trump's clean sweep of 7 swing states and optimism on a more crypto-friendly Congress. The crypto industry expects a more favorable regulatory environment and potentially approval of more ETFs from the president-elect's upcoming government. The value of Bitcoin, the world's biggest cryptocurrency, has now risen by nearly 90% this year. That's your Bloomberg Brief. Anne-Marie?
Thanks so much, Yahira. Up next, we're going to set you up for your week ahead. You're watching Bloomberg Surveillance. Good morning. Let's count you down to the opening bell. Here's the trading diary for the week ahead. Tuesday, Home Depot reports earnings, plus we'll get Fed speak from Waller. Wednesday, we have CPI, more remarks from Kashkari and Musalem. Thursday, PPI plus Fed speak from Powell, Kugler, Barkin, and Williams. And Disney reports after the closing bell on Friday. We get retail sales. And the presidential transition of power is currently underway. President Biden is set to host President-elect Donald Trump at the White House on Wednesday. Bloomberg's Mike Shepard joins us now. Mike, to be a fly on that wall, what can we expect from that meeting?
Well, Anne-Marie, it's certainly not the meeting that Joe Biden was hoping to have a few weeks ago. He really has, since he took office and in his run against Trump in 2020, really decried the man who is now the president-elect of the United States as somebody who is unfit to hold the nation's highest office. Yet here we are, and Biden is preparing to host him there to carry out what he is promising to be a peaceful and orderly transition of power. Again, that is a contrast from back in 2021, as you and I both recall so well, when Donald Trump was refusing to acknowledge the results of the election and even refused to invite Biden in for a visit ahead of returning to office. And Trump will be going there not just to measure the drapes. He is already thinking about and plotting out what will his new administration look like. And Biden will, at the same time, be trying to hold on to some of his policy priorities, including Ukraine, as we heard from Jake Sullivan over the weekend.
I'm not sure he really needs to be worried about measuring the drapes since he's already occupied that office. Bloomberg's Mike Shepard, thank you so much. For me, it's really going to be about personnel. When are we going to get the Treasury Secretary pick? But of course, this week we also have a ton of data.
And I think we've talked about this morning as to where Robert Lighthizer may fit in and where Scott Bessent, or indeed it could be any other names as well out there that could fit in there. And then who chastens Donald Trump's policies and interprets it for him in terms of what the market is going to look at.
I just wonder if it's Scott Bessent. Are we off to the races again? Is it risk assets? Bid. One more time.
And then the betting markets were accurate once again. All right, coming up on the program tomorrow, thank you, Danny and Manis, for joining me with John and Lisa out. Christian Mueller-Glissman of Goldman Sachs, Tom Steyer of Galvanized Climate Solutions, Jim Caron of Morgan Stanley, and Sonia Meskin of UBS. This was Bloomberg Surveillance, and this is Bloomberg TV.